There should be some broadening out, but we are not ready to bet against tech.
The hyperscalers are going to drive more and more of the outcomes.
I am kind of keen on the impressive 493. Everybody's focusing on the magnificent 7.
The majority of these companies have very, very robust cash flow.
Investors have really gotten bulled up on is a very strong economy in 2026.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday at all-time highs. Memory stocks powering equity markets to the first records of 26. The president claiming Venezuela will send the U.S. millions of barrels of crude. And the White House refusing to rule out military action to take Greenland. It's a fast start to a brand new year.
We have so many intense geopolitical headlines, and they are not registering in any way in markets. We're getting an everything rally. Yes, we're getting the chip stocks making new all-time highs. Memory stocks in particular absolutely surging. But on the flip side, it's everything. You're seeing it also in small caps. You're seeing the broadening out. You're also seeing it even in credit. At the same time, you have these risks front and focus that people can't even begin to quantify, so they're just not.
The one place we are seeing some of this bleed out into financial markets is in the commodity space, whether or not it's metals that are going up or the oil price, which is actually getting a little bit softer based off what the president is saying. Yesterday, talking about 30 to 50 million barrels of oil coming into the United States. That's about 2 to 3 months potentially. You have to take out Chevrons because their oil's not sanctioned. 2 to 3 months of oil, and the president said it's going to be run by him. Makes you think, okay, is this a slush fund, or is this potentially going to the Strategic Petroleum Reserve? There's a lot of questions we still have regarding this crude.
Crude this morning, 56.87. We're down about 0.5%. Check out the week ahead. New feature on that. Check out Friday, not payrolls. Supreme Court opinions this Friday. That gets your attention going into the weekend.
Especially because right now, prediction markets have a 20 to 30% chance that the Supreme Court will rule for tariffs. That means there is a 70 to 80% chance that they'll rule against IEEPA as being used as justification for the broad-based tariffs that President Trump put in place. Are we underestimating the risk of what this means for the fiscal backdrop, whether this is a positive, whether this is disinflationary, or how exactly people are going to wrap their heads around this?
The president talked about this yesterday. He was talking about the fact that what is wrong with the public, they don't understand what we're doing. And then he also said we have a big Supreme Court case. I hope they do what's good for our country. Even if the Supreme Court, though, does strike down IEEPA, it's going to take months and it's going to bleed into the midterm election season. But this administration will continue using tariffs. They'll just use other legal avenues.
At least for now, the bond market is not spooked. If you check out fixed income this morning, 2s out to 30s. We've got a rally this morning. Yields are down by 3 basis points, 10s at 414. Bramo right at the long end of the curve, 30s down 4 basis points, 482.
Yeah, you're getting disinflation, or at least a disinflationary feel over in Europe. And people expect that in the United States, aside from some of the tariff influence, you're going to see ongoing disinflation. I don't know about the fiscal. You put IEEPA in there, you talk about, somehow newly realigning global orders. I mean, you're right to point out that this is a notable sort of sanguine feel in bond markets. Can I explain it? It's just that the data is coming in better than good.
It could be messy. It's a risk factor. If you're just joining us this morning, good morning. Futures lower by about 1/10%. Coming up this hour, we'll catch up with Cameron Dawson of NewEdge Wealth, with stocks close to record highs. Amy Gower of Morgan Stanley with metals on a tear. And George Saravelos of Deutsche Bank on why the US dollar could see further weakness ahead. We begin this hour with stocks pulling back from all-time highs. Cameron Dawson of NewEdge Wealth seeing more room to run, writing 26 begins with one-sided bullish sentiment, rich valuations, optimistic growth forecast, however, positioning still, a double still, not stretched. We could continue to see a chase higher. Cameron joins us now for more. Cam, good morning.
Good morning.
Let's start with positioning.
Yeah.
You look at it and you say still not stretched.
Yeah.
What gives you that idea that things still aren't stretched?
Yeah, positioning was the story of 2025. The fact that we got to the first percentile of positioning back in the aftermath of Liberation Day, and we never got to an overweight position for institutional investors. So despite the fact that there was resounding bullishness as far as sentiment, despite the fact that we saw households get to max bullish sentiment, institutional investors are still sitting in this neutral territory. We think that's why, as you look at 2025, every dip got bought. Dips were very short and shallow. And that likely continues in the first part of 2026, at least simply because you're not in that stretch positioning area, despite the fact that there's no bears when it comes to strategists. And there are certain signs of complacency in different areas. Look at the VIX, look at positioning in the VIX. But again, you have overall positioning that still remains just neutral.
What is the credible bear case for you coming into the new year?
I think that earnings estimates are already quite high. They are baking in at $310 a share, 200 basis points of margin expansion, which means that we are already counting on a big productivity boom in the numbers today. If that starts to disappoint or even just go sideways, that would be something that would likely cause markets to have more volatility simply because you're trading at high valuations. The reason why you've been able to trade at high valuations and continue to see markets press higher is because earnings estimates and GDP estimates were both pressing higher. If that starts to flatten or potentially turn lower, that's when you'll see volatility start to come in.
That's the reason why some people are actually using bonds as a hedge, because you could start to see an underperformance there and then the ongoing disinflation. What about the other side? This idea that people are baking in 2 to 3 Fed rate cuts at the same time as a global reacceleration in growth. Yeah. Can you square that circle?
Yeah, it is pretty astounding because if you look at equity market leadership, it has been since November sending a very clear signal about an expectation for global reacceleration. You look at industrial commodities, you look at discretionary versus staples, industrials overall outperforming, banks outperforming. All of this shows signs that the market is optimism about global reacceleration. I would paint the contrast of the narratives to the start of last year when it was all about America first, everything in America is wonderful. And look how that played out in the first half of the year. That certainly didn't drive powerful outperformance. So is this global reacceleration simply something that it's a narrative that we should fade given how dominant it has been?
So what's the answer? Is the answer to fade this sort of broadening out trade that everyone is confident about once again?
Not yet. So if you look at typical seasonality for cyclicals, the best time to own them is November through April. Sell in May and go away actually does work for cyclicals. And I think the big test will be is, do you start to see the real data start to confirm this cyclical optimism? Do you see earnings start to confirm this cyclical optimism? There's been this notion that because PMIs are at 47, which implies contraction, that we are early cycle or that we have a lot of pent-up demand when it comes to things like cyclicals and industrials. But note that industrial earnings are at record highs. So this has not been an environment where you see some kind of depressed demand. And the other interesting thing is that industrials are trading at 24 times earnings. That's the highest level since the lows back in the COVID time when earnings effectively doubled over the next 2 years. So you're putting peak on peak in some of these cyclical trades, but they can still run just because of seasonality.
Are you concerned that there's a lot of consensus as there was last year?
Yeah, I think you have to be concerned because just as everybody agrees on something, that's usually the time that you get the most surprised. I'd use the dollar as an example. Going into last year, everybody had consensus that the dollar was going to strengthen. It was the America First trade, and it showed up in positioning. International money market positioning was max long the dollar. That created the fuel for the unwind in the dollar, and thus the dollar weakness in the first half of the year. You look at that today, positioning is actually slightly negative. So everybody is saying that the dollar is going to be weaker, that there's more room for dollar weakness. Yes, the technicals don't look great, but people are already positioned for it. And so I think that that's where the surprises could come in, is everybody's already on one side of the boat.
Do you actually think this year we will see the continuous weakness of the dollar?
I don't think yet. I think because of positioning, you're still in an environment where we likely chop sideways. The dollar has been effectively flat for 9 months. So all of this talk about America coming under pressure because of tariffs hasn't resulted in a weaker dollar because of positioning. So if you get to an environment where people start putting positioning to be a little bit more long, or you get some kind of exogenous shock, maybe you get further dollar weakness. But for now, we don't see that tender there.
I'm pleased you said that. Bring up the chart again and take a look at it. Sold out of the gate as we opened 2025. And then since the middle of last year, May, June time, that trade has done absolutely nothing. And we'll have another guest later this hour saying, guess what? We're looking for further dollar weakness.
Everyone right now is getting behind this idea that the dollar is still overvalued, right? That it's not just about some kind of question about the U.S.'s fiscal status in the world, but just that it had been really overvalued for about a decade. A real question here about what the driver is and what's the offset to it. Is it the euro? Is it the yen? Is it gold? How much are we looking at a very new environment when it comes to commodities?
Best year since the 70s, silver. Gold, precious metals, throw in other metals too, copper, the last week as well, blasting through 13K. What's the story that's emerging there, developing? What does it tell you?
I think that there's an aspect of fear, and that being the best way to express your fears about things like fiscal dominance without having to get exposure to concerns about growth. So if you think about the 10-year Treasury as a potential hedge for growth fears and fiscal dominance, that's where you say, okay, let's look at gold as being the better option for that. And it's been in a powerful, extraordinary uptrend. I think the bigger question is, why is Bitcoin sat out of that? If those are your fears, why haven't you seen that reflected in Bitcoin? Maybe around the margin, there's some liquidity concerns that are being reflected there. But the trend continues to be your friend, even though it's certainly had a powerful run.
I guess just to build on that, there's a feeling that Bitcoin you can't use to build a data center. You can't use Bitcoin to make beautiful jewelry that you're going to wear to your Indian wedding. A real question here going forward about whether the precious metals and frankly just industrial metals are exploding because of this new investment in the real economy that still has legs, or whether that trade is done.
We have been in an environment really since the peak of the commodity bubble back in 2014 where we have been underinvesting in commodity type of infrastructure. And so there's been big bull cases that commodities are going to rally because these are very long cycle investments. And just now, after all of these years of underinvestment, you're starting to see that start to percolate and show up in prices. So maybe that's the story. And the question we're asking, is this a repeat of 2000 to 2007? That was the last commodity supercycle we had, and that ushered in a time where you had growth significantly underperforming, value outperforming, international over U.S., small over large, massive changes in leadership that coincided with that industrial metals and overall commodity supercycle. So a repeat of that, which is not necessarily our base case, would certainly usher in massive leadership change.
Cam, you're going to stick with us. Cameron Dawson there of NewEdge Wealth. Speaking of copper this morning, pulling back from all-time highs. We're down about 0.75% over in London. Let's get you an update on stories worldwide this morning. Let's cross over to Bloomberg's Yahara Anand with more. Hey, Yahara.
Hi, John. Crude prices are weakening after President Donald Trump said Venezuela will send up to 50 million barrels of oil to the U.S. That's worth roughly $2.8 billion at the current market price and represents about 50 days of Venezuelan oil production. Sources telling us here at Bloomberg that President Trump could meet with energy executives at the White House as soon as tomorrow. Meanwhile, Russia is sending Navy ships to escort a sanctioned oil tanker, which is being pursued by U.S. forces across the Atlantic. Multiple sources reporting the ship, which is said to be empty, has historically transported Venezuelan oil. President Trump said last month he was ordering a blockade of sanctioned oil tankers entering and leaving Venezuela. And tensions between the U.S. and Greenland ramping up again. President Trump won't rule out the use of military force to acquire the Arctic island, as the White House says the administration is weighing a wide range of options. Denmark's prime minister warning that any U.S. attack on Greenland would spell the end of NATO. That's your Bloomberg Brief. John?
Yahara, thank you. It's hard to take it seriously, but you kind of have to take it seriously.
Well, Marco Rubio, according to the Wall Street Journal, is telling lawmakers we're not trying to invade, we're trying to buy. And we're just using this invasion tactic and this rhetoric to get them to the negotiating table.
It just wasn't on my bingo card to try to go after the Denmark prime minister and capture a land with, I think, 40,000 people who live there?
It was on mine, only because if you read the national security strategy from this administration, they really care about rare earths. They care about shipping and submarine lanes. They do not want China and Russia having access to that so close to Europe, where they spend, billions of dollars to be part of this collective NATO defense. And Trump has been talking about this since his first term.
Your bingo cards are very different. Bramo's bingo card is just one thing. It's like fiscal concerns.
100%.
Right.
Bond yields rising.
We should actually merge our bingo cards. We would be unstoppable.
Up next on the program, let's talk about crude. Drill, baby, drill.
I'm also meeting with oil companies. Let's go. You know what that's about. We've got a lot of oil to drill, which is going to bring down oil prices even further.
Up next, we'll catch up with Bloomberg's Jonathan Tamari in just a moment. From New York City this morning, good morning. Decent start to the new year. 3-day winning streak on the S&P 500 in the green every single day so far in 2026. This morning pulling back by about 1/10% on the S&P. On the Nasdaq, we're down by 0.3. Slight move lower on the Russell. Small caps down by 0.06%. And the Saravelos this morning, drill, baby, drill.
It was an amazing military feat that took place. It was so complex. 152 airplanes, many. Talk about boots on the ground. We have the most powerful, most lethal, most sophisticated, and most fearsome. It's a fearsome military on planet Earth. I'm also meeting with oil companies. Let's go. You know what that's about. We've got a lot of oil to drill, which is going to bring down oil prices even further.
So here's the latest this morning. President Donald Trump saying Venezuela will send the US as much as 50 million barrels of oil, worth up to $2.8 billion. Trump is also said to be demanding the country reduce its ties with US adversaries. Joining us now is Bloomberg's Jonathan Tamari. He joins us from Washington. Jonathan, welcome to the program. Has Venezuela confirmed any of this? What's your read on what's about to happen?
We have not received confirmation from Venezuela, so this is often the case. We've seen the president make announcements that are not necessarily reciprocated by other countries. But obviously, in this case, the U.S. government has significant power in this situation. They've said that they're willing to use coercion to get what they want. And I think this is a way of the president trying to show Americans, listen, this isn't just about removing a dictator. He's trying, the biggest issue domestically is cost of living, prices. We have an election year coming up. And I think this is probably a way for the president to try to say to people, listen, this is going to benefit you directly by lowering prices at the pump, potentially.
Well, it's helping this morning. We're down to 56.83. I'm not sure that's helping the oil majors as they think about increasing capex, Jonathan. Can you help me understand that piece of it? The president's got a very, very aggressive timeline. Can he bring private companies, I stress private companies, US oil majors, along with him?
I mean, that is a huge question because this incident itself just shows the risks of investing in a place like Venezuela. There's so much instability. Things can change so fast. We're talking about very long-term investments to try to rebuild the infrastructure in the way that he's talking about. And if prices are going down, that decreases the motivation to make those kind of investments. And there's no telling what's going to happen in Venezuela going forward. The president and his administration have not laid out a lot of detail yet about what comes next. So I think he's got a lot of selling to do when it comes to convincing people to invest there. There will be a new administration at some point, and it's not clear even, if this kind of policy will continue then.
Jonathan, thank you, sir, for the update. Jonathan Tamari of Bloomberg down in Washington, D.C. Are we going to be taking stakes in Chevron next? I'm joking.
Well, no, maybe
I shouldn't be.
I was about to say,
you might give Mike Wirth a heart attack.
I mean, frankly, he might have already had that heart attack because what does it mean for the U.S. government to backstop investments potentially in Venezuela?
You know the point I'm making? We don't have a state oil producer in the United States of America.
Yet.
The White House can come along and say, drill, baby, drill. These guys are being pretty tight when it comes to spending. Do they really want to go into Venezuela at the moment without a clear understanding of what's happening with crude below 60?
Yeah, and the other point, just to build on that, Trump said that this is incredibly high-quality oil. This is sludge, right? And there's a real feeling right now that in order to refine this, you need to have special refining capabilities, which you have here in the United States with the likes of Valero, which is continuing to rise. A question, though, of how quickly you can really get this going, what it replaces, look over at Canada, and how much it really will add to the U.S. oil supplies.
I made this point yesterday. Donald Trump is the only person I have ever heard in my life talk about Venezuelan crude as high quality. It's high sulfur, it's low hydrogen, it is definitely not high quality. But also, for a little bit of context about how we're going to feel it at the pump, 30 to 50 million barrels a day is about 2 to 3 days of U.S. oil production. That's what we're talking about. It's not crazy amount, given how big of a producer we are right here in the continental USA.
And because of that, that's why we've got these prices right now, 56.85. Cameron Dawson of NewEdge Wealth is still with us. Cam, sub-60 crude. Mm-hmm. Can you just frame the importance of that for this economy, for consumers in America, and maybe even for this market too?
It's probably been one of the most important things over the last 3 years. Going from over $100 a barrel in oil down to sub-60, going from $5 a gallon in gasoline to now $2.80. It's fallen by 30 cents in the past month or so alone. That has allowed for disinflation on headline inflation. It has acted as effectively a tax cut to consumers. It's allowed consumers to feel better. Real wage growth has held up better because of these falling energy prices. And so the question is, we have affordability issues, but it's not necessarily at the pump and gasoline prices, with gasoline prices at $2.80 a gallon. How much lower can they go? How much incenting can you do to oil producers to continue to increase production at these levels? These are really important questions.
Yeah, and people were wondering whether it was valid to see the energy majors rally in the face of some of the recent announcements, despite the fact that oil prices were lower. For 2 straight days, we saw that rally. Today, not so much, losing a little bit of that as people reassess exactly what that looks like. How do you assess that into your market call?
Well, I think that you have to ask the question, are there things that the administration can do to allow oil companies to experience higher earnings and not necessarily need higher oil prices? Meaning, are there certain tax incentives that could happen to incentivize production? Because at this point, you're starting to get near break-even levels that start to look very unattractive. And don't forget, back about 10 years ago, we had this renaissance within oil companies where all of a sudden they started caring about return on invested capital. Investors started to look at oil companies and said, why do you take every dollar that you earn and pump it back into the ground and create this environment where returns continue to compress? So we're still in this capital discipline type of environment, which doesn't necessarily support more oil investment at these levels.
So I know that John was a little bit tongue-in-cheek when he said the U.S. doesn't own Chevron. And then we all said, well, yet. Or maybe, it's sort of a question of how state involvement and having a state champion changes your view as an investor.
Well, I mean, it's interesting when you talk to emerging markets investors and you ask them, how do you deal with state-owned enterprises? And the response has been, well, wouldn't you want to be aligned with the state and the people that have unending money printing power? So I think it's a really good question. I mean, look, at the end of the day, we think that markets are driven by earnings. And so if this involvement allows earnings revisions to finally turn higher for equity, for these companies over the last 3 years, they've been in a constant decline lower because of oil prices, then maybe it could be a bullish scenario, but not necessarily a bullish scenario for free market capitalism.
My counter to these EM investors would be, with the state intervenes, it diminishes competition. And we've already seen the United States intervene last year in Intel and a number of other companies. Do you expect, if that continues, that these are still worthwhile companies to buy?
Lest we forget that the largest weights in the U.S. equity market are all effective monopolies. So there's not a lot of competition in those businesses as it stands. They have incredible pricing power, and we think that's actually one of the things that people are underappreciating over the last 3 years. Everybody but looks at the end of 2022 and say, well, that was ChatGPT releasing, and that has caused a huge rise in the earnings of the Mag 7. Yes, in part. But we think the other part of it has been the fact that companies effectively looked in the mirror. They said, we have monopolistic pricing power. We're going to raise prices, and we can actually cut headcount because of some of this AI efficiency driving tools.
Cam, thoughtful stuff. It's good to see you. Thanks for being here. Happy New Year. Cameron Dawson there of NewEdge Wealth. You joked about it. I'm right there with you. I hope Mike Worth's not watching this morning because he might have a heart attack over at Chevron.
Absolutely. And Chevron, Exxon, all these companies are going to be lining up. The president is inviting them. They're going to go to the White House for this discussion, some of the smaller oil producers as well, later in the week. It's very easy for them to go have this chat with the president of the United States at the White House. It's going to be very difficult for them to want to take that CapEx and put it in a place like Caracas, where there's an incredible amount of political instability.
Yeah, we're not talking about Saudi Aramco, are we? These aren't levers you can just pull and things happen. They're accountable to shareholders, which is why they haven't been spending the way they were many years back.
Yeah, and it's the reason why they want to see the money that they already have lost in the region. At the same time, there's 11 ships from Chevron heading over to get some oil to bring back to the U.S. It's clear there is some cooperation here.
Coming up on the programme, we'll catch up with Amy Gower of Morgan Stanley as copper trades near a fresh record high. Plus, Danny's going to drop by. She's got some morning movers for you. We'll get to Danny on that in just a moment. From New York City this morning, good morning. The first record high of the year in the books in yesterday's session. 3-day winning streak on the S&P 500. Slight pullback so far this morning. Down by around about 0.1% on the S&P. On the Nasdaq, we're down by a third. The consumer discretionary part of the equity market perking up again in yesterday's session. Also the banks going into earnings next week. JPMorgan just around the corner. The banks trading at record highs.
And it's on the back of a steepening yield curve and an M&A boom. I mean, you talk about the biotech sector. Suddenly there's a boom in deals there. We saw a boom in deals in the tech sector at the end of last year. How much are banks going to capitalize on this, especially with lighter regulation?
We'll get to some of that in just a moment. Let's turn to the bond market, Bramo. Yields down across the curve. On 10 we're down by, let's call it 3 basis points. 30's down by 4. Tons of events this week. You can point to payrolls or the jobs data and say that's really, really important for the bond market. You could also point to this. Opinions from the Supreme Court on Friday as being potentially consequential for what happens here in fixed income.
On one hand, you could say if the Supreme Court were to overturn tariffs that were implemented under the IEEPA Act, you would essentially get a disinflationary force because some of the tariff-related inflation would not come to pass. On the flip side, and this is really what people are looking at, the fiscal side, how much does this really add to the fiscal deficit, and how can this really be plugged, even with additional measures by President Trump, just because this is an election year, and they are not going to want to add to costs for consumers.
It's a great point because it's an election year. We already have the one big beautiful bill. We're going to get the tax refunds. The big question mark, and I got a question from someone in Washington actually this morning. What is the market banking on coming out fiscally from Washington, D.C.? Because they're looking at it in a granular way, and they're like, we don't see any movement in votes. And I was like, well, the market realizes it's an election year, and this administration might be very aggressive on trying to get some more stimulus through. Those $2,000 tariff dividend checks. I'm not saying they're happening, but there's still talk of something like that.
It speaks to what's been developing in the metal space for quite a while. Copper, all-time highs earlier in the week. Massive year for both silver and gold through 2025. Pulling back from some of those records this morning. Gold's down by about 0.8%. Silver down by 2.2%. But the theme, the grain has been going in the other direction.
And right now the theme is that this is because of people looking for an alternative to fiat currencies, but this is also because the real world is reasserting itself as sort of the revenge of actual stuff rather than the financialization and the digitalization of everything. Suddenly we got to build things, and everyone's realizing that and investing in the materials that they need to use.
13K on copper. We'll come back to that in just a moment. As we count you down to the opening bell about 3 hours away, let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. I got another really big market theme for the year so far of 2026, and that is the huge move in a lot of these memory chip stocks. You're just looking at yesterday's session. I don't know if we have this morning's session as well, but all of these hitting new records, helped by Jensen Huang saying that the demand for memory is only going to increase with the demand for AI. All these stocks in the pre-market this morning are down, so a little bit of a cooling off for some of this trade, but you can see just how big the gains were on yesterday's session. Elsewhere this morning, we do have a little bit of deal news. Lisa hinted at this. Ventex, this is a Wall Street Journal report that Eli Lilly will be buying this biotech company for about $1 billion. They make anti-inflammatory treatments, a hot area of healthcare at this moment. Their valuation is around $500 million, so it is a big premium that Eli Lilly will be paying if this deal gets announced. Shares are up just under 68%. Finally, wrapping things up with another company that had a huge day yesterday. Critical Metals surged 26% yesterday. It's up 12.5% in the pre-market after that Reuters report that the Trump administration is looking at various options for acquiring Greenland. This is a metals company, a mining company, and their flagship project is a critical minerals one in Greenland. So that's why you're seeing the shares move this morning, John.
We just need to open a company and register it in Greenland. You on board? Ready to go?
100%. I was just thinking we should just name it, essential metals. Metals are us.
Done.
Metals Arama, and put it in Greenland.
What do the grifters do? They start a SPAC, right? Should we just...
I think so. Right. I think we could raise
money.
money.
What are we doing? Working, Bramo.
I mean, honestly, please, send your checks.
On our radar this morning, not that, this. President Donald Trump announcing Venezuela will send up to 50 million barrels of crude to the U.S. worth roughly $2.8 billion. The oil expected to be sold at market price, with the proceeds benefiting both countries. Elsewhere, Secretary of State Marco Rubio reportedly telling lawmakers President Trump is aiming to buy Greenland, not invade it. According to the Wall Street Journal, the administration's aggressive rhetoric is a tactic to pressure Denmark into a sale. And finally, China, intensifying its trade standoff with Japan, launching an anti-dumping probe into a critical chip-making material. The move following a formal protest from Japan over China's recent export controls on items that could have military uses.
To me, the fact that China is using its rare earth minerals exports as a potential node of geopolitical negotiation or coercion highlights the potential risk that people didn't even want to talk about over the past couple of trading sessions, which is what happens if they do the same thing with the United States? The whole question around Taiwan and how essential it is with respect to chips, and then also China and how essential it is to rare earth minerals, really highlights how this could be used as a potential negotiating tool and, frankly, a big risk out there.
And this has been brewing for months. Basically, when you had the new Japanese prime minister come out and make some remarks about Taiwan, you have seen this tit for tat. But it's really important, those rare earths, not just for military use when you're looking at the United States and Japan, but also the auto sector. That is huge for Japan. And not having access to some of those important commodities is going to be a big problem for their industrial.
Let's talk about some of those commodities right now. The rally more broadly taking a breather after lifting metals to record highs. Amy Gower of Morgan Stanley saying the outlook for metals remains strong, with rate cuts, potential for more dollar weakness and investor demand for real assets. Amy joins us now for more. Amy, welcome to the programme. Let's just start with the latest leg higher in the copper rally. What's behind it?
Yeah, look, I think we absolutely came into 2026 with a very strong backdrop for metals as a whole, and particularly for things like copper. So as you mentioned, the rate cutting cycle, that's a tailwind for commodities, non-yielding assets, also helpful for many of the end use sectors that metals depend on, things like construction, autos. So those rate cuts are supportive. We also have investors looking for real asset exposure, and a lot of that within commodities seems to be going into the metal space at the moment. And then for copper specifically, I would say you've had this very, very tight supply backdrop through 2025. Many of the disruptions we had there are spilling over into 2026. And then also the US is scooping up every spare ton of copper available. And that really accelerated through December. And I think the market has come back. It's a new year. Everyone's looking at this data and waking up to the fact that although we do have a lot of inventory in the US, it's not really acting as inventory at the moment. It's sort of locked there and unlikely to leave.
Amy, for a long time when it came to copper, we just talk about one thing. Show me Chinese demand and we'll figure out what's going to happen with copper prices. Are the characteristics of this metal changing?
Yeah, look, I think Chinese demand absolutely is still important. And I think when there's clarity one way or another on whether the US might introduce copper tariffs in 2027, which is currently a floated possibility, then I think the market will start to focus again on Chinese demand. But absolutely, I think this is shifting. You know, historically, China probably drove almost all of the demand growth we had over the last 10 years. And if we look at the next 10 years, the drivers might still be in China, but there are things like data centers, stationary storage batteries, the grid. So these are drivers that we know will keep developing. But it is worth saying Chinese demand is looking a little soft. But at the moment, the market's not really feeling that, because where there might be any excess metal, it's just making its way over to the US.
We've been focusing a lot on Latin America recently and how the US is looking to assert more dominance over the region. And a lot of this has to do with the likes of copper and lithium and nickel and some of these other precious metals that are found in abundance in certain regions. How much are you analyzing where production is coming from and how this represents a node of geopolitical positioning at a time where these are crucial minerals for the entire build out of data centers and everything you just mentioned?
Yeah, look, I think it's always good to be aware of where the key production centers are. So if there is any geopolitical risk in a particular region or any other disruptions for that matter, you know how important that region is. And I think the world is waking up to the fact that it's not enough just to have the downstream processing facilities or have that import relationship, but also to make sure that you've got access to that upstream materials as well. So we are seeing more investment both from the US, but also from China in upstream capacity. And you can't really change your own geology. So what you're then having to do is look at other countries and see where there can be partnerships. So that may be how we drive some investment over the next few years. But the one thing I would say is these lead times for new mines are still very, very long. And so even if we're investing today, it's probably going to be well into the 2030s before we're getting meaningful production growth.
Based on that, I'd love to pick up on what Cameron Dawson was just talking about, which the last time we saw a commodity supercycle was from 2000 to 2007, and it was really a massive influence over markets more broadly. Do you see that taking shape? Is this the beginning of that, or is this the middle, or is this just a head fake?
I think, super cycles is always difficult to define, but I think especially given we're seeing energy weakness. So we're not seeing it, I guess, across the whole commodity spectrum. But I would say in metals, absolutely, it does feel like the world is waking up to the importance of metals. The fact that, we probably have underinvested in many of the metals since the 2015-16 downturn. We never really saw that investment recovery coming through. And so there just isn't that pipeline of supply that we would maybe have had historically at these prices. And so we're now probably getting to prices where we need to start thinking about demand destruction levels. Now, commodities are always cyclical, and I think, as I mentioned on copper, we are seeing a bit of demand weakness at these prices. Whether that's just a temporary pause in purchases or whether that's true demand destruction, I think we need to wait a bit longer to see. But I think, it feels like at the moment we're certainly in a very strong setup for metals.
Amy, when it comes to copper specifically, what about the ongoing threat of import tariffs from the U.S. administration? Is that something you're still watching?
Yeah, absolutely. So this is one of the key drivers for copper for this year. So the US has floated the idea of a 15% import tariff from 2027 on refined copper. This was something that was considered last year and ultimately put on hold. But what that means in the meantime is that there is an incentive to send metal to the US ahead of time and essentially stockpile it ahead of any potential tariff. We're due to hear on that around the middle of the year. So at least for the next 6 months or so, there is incentive to keep sending metal to the US. And then if they do ultimately decide to go ahead with tariffs, then I think that would continue through the second half of the year. Probably the most bearish risk for copper at the moment would be that the US comes out around that mid-year point and says, we will not do tariffs on copper, and we're kind of taking that off the table as an option. And then in that case, you do have a lot of inventory sat in the US, which could suddenly be released. But that could still be 6 months away. And at the moment, if we look at what they've done in steel and aluminium, where we do have tariffs, it would look probably more likely than not that we may see some copper tariffs as well.
Well, given that potential mid-year of not having those tariffs, is the level today justified?
I would say for now, it feels justified. We have been more bullish on the first half of the year than the second half, just given that uncertainty that we have around mid-year. It's always tricky to come up with the exact price level that copper should be at. But I would say, given we have this bid from the US, that is creating a market that feels like it's in real scarcity at the moment. It's sort of starving the rest of the world of metal. And Lunar New Year in China, which would typically be a bit of a softer spot from demand, that's still over a month away. So we could still have this period of time where copper continues to feel very tight.
Amy, thank you. Thanks for jumping on and making time for us. Amy Gower there of Morgan Stanley. The latest on metals and mining. Copper this morning pulling back by around 1%. Let's get you an update on stories worldwide with your Bloomberg brief. Let's check in with Yahira. Hey, Yahira.
Hi, John. President Donald Trump urging House Republicans to turn around their political fortunes ahead of November's midterm elections. Trump warning if Democrats retake control of Congress, he will be impeached for a third time. The president telling them, quote, "You got to win the midterms." Meanwhile, Elon Musk's xAI has completed a $20 billion funding round with investors, including NVIDIA and the Qatar Investment Authority. xAI saying the financing will accelerate infrastructure build-out and develop AI products, including its chatbot, Grok. And Berkshire Hathaway's new CEO, Greg Abel, will earn an annual cash salary of $25 million, far eclipsing the $100,000 that his predecessor Warren Buffett earned for decades in the role. Buffett ceded the CEO role to Abel at the start of this year. The billionaire at 95 is still serving as chairman of the company. That's your Bloomberg Brief. John?
Not bad. Yahira, thank you. Appreciate it. Up next, risks to dollar dominance.
Something similar to what you saw in Q2 of last year, which is you saw a massive move lower in the US dollar. We think that kind of a trend will continue this year. The dollar will likely remain overvalued in the long term, but unfortunately, I don't think that prevents the dollar's collapse in the short term.
A conversation up next with George Saravelos of Deutsche Bank, live from New York City. You're watching Bloomberg TV. No drama this morning, just a little bit softer. We're down by 0.1% on the S&P, down by 0.25% on the Nasdaq 100. On the Russell so far this morning, the small caps just about unchanged. Under surveillance this morning, risks to dollar dominance.
Something similar to what you saw in Q2 of last year, which is you saw a massive move lower in the US dollar. We think that that kind of a trend will continue this year, where people will continue to question if the dollar is really a safe haven or not, because the list of risk events in the US is endless. The dollar will likely remain overvalued in the long term, but unfortunately, I don't think that prevents the dollar's collapse in the short term.
Collapse is a strong word, isn't it? We'll get to that in a minute. OK, the latest this morning, the greenback off to a strong start to the year as investors await the next big catalyst, starting with payrolls due on Friday. George Saravelos of Deutsche Bank writing, we project further dollar weakness, but at a slower pace than 25. George joins us now for more. George, welcome to the programme and a Happy New Year to you, sir. Let's start with the chart. The chart of DXY, the dollar index, sold aggressively as we started 2025 and flatlined since May, June of last year. It's basically done nothing. So can we deal with that first? What's behind the nothing over the last 6 months?
Happy New Year to you as well, John. So we definitely saw the DXY, as you say, stabilize around the summer, but effectively the dollar weakness rotated from some of the developed currencies to emerging markets. So we have to remember dollar China started moving sharply lower from the summer onwards, a lot of emerging market currencies. So actually, if you look at the trade-weighted dollar, the broad trade-weighted dollar, it was moving down pretty much throughout the year. And in fact, in December, I just updated some of my own charts. The full year drop in the dollar in 25 was the second biggest drop on record since free-floating exchange rate started after Bretton Woods. So it was a very big year for FX. I would argue it's going to be very difficult to repeat that type of move in 26, though there's certainly a lot of interesting stories going on, of course, in the background.
Well, let's explore some of that a little bit further, George. So if you are anticipating further dollar weakness, give us the why. And then two, just to build on what you said, how to play it and what against.
So the why is mostly on the back of cyclical reasons, because there is an underlying story around dollar dominance. But if you go back, you see those properties of the dollar that make it dominant in payments, in reserves. These take decades to change. So the view is more about the cyclical dynamics. And there's a couple of things that have happened over the last 12 months. The first thing is the dollar is no longer the world's highest yielding currency. In developed markets, at least, because the Fed's been cutting rates as everyone else has stopped doing the same. And empirically, the dollar being a high yielder is a big deal. And when it no longer is a high yielder, and you've got other currencies now, for example, in Australia or in Norway, taking on that property, that removes a big tailwind for the dollar. So that's number one. Number two is if you look at the global composition of growth, over the last few years, the US was leading the pack. And what you've seen over the last 12 months is global growth broaden out to other economies as well. Europe is, of course, doing fiscal stimulus. Japan is potentially joining. So overall, a solid global growth outlook, but with growth convergence, and the dollar being less of a high yielder, plus a very large external deficit that's very reliant on AI inflows. That's pretty much the mix that I think should allow the dollar to continue to weaken, but at a much slower pace than we saw last year.
How much of a risk is that, George, the idea that the luster around the AI trade, or at least the acceleration in some of the production, tempers and you don't get those AI flows into the United States? How much would that be a bear case for the U.S. dollar?
So I think the AI story is very important, and I would point to two different dimensions. The first one is if you look at the funding of the U.S. current account deficit, which, remember, despite the tariffs, still looks like it's around 4% of GDP, historically very elevated. Now, that requires funding. It requires inflow. And if you look at the last 12 months, equity inflows, predominantly, of course, going to the AI sector, have nearly fully funded the U.S. current account deficit, and that's a record high. So the first point to make is the U.S. is very reliant on equity funding for its current account deficit, and by extension, its fiscal deficit. The second point to make is if you look at the concentration in US equities. Of course, there's focus on valuations, PE ratios, but what I care more about is concentration. So what is the share of the top 5, top 10 companies in S&P? That's at record highs. That's around 45% of the S&P market cap is the 10 largest companies. Now, what that means is you've just got high concentration risk. If something goes wrong in any one of those companies, the stock market in the US and by extension the dollar is more vulnerable. So I think about it less in terms of, do we have a big down year in equities? What is the valuation argument in AI? And just more about diversification. And for the first time in a long while, the rest of the world is just more diversified. So if you want to be exposed to long risk assets, you just have more diversity if you're exposed in the rest of the world. And the US is just very, very concentrated in this AI story. So it's an asymmetric downside risk.
That's a risk sort of on the horizon, a what-if scenario. There's also the potential risk event Friday. We get the Supreme Court ruling potentially on IEEPA and the tariffs that President Trump put on for the bulk of last year. What does the dollar do if those are overturned?
So I'm skeptical you will see a large market reaction for the reason that I think very, very quickly you will see the administration replicate those tariffs with effectively Section 301 country investigations. And we did get some indication of how that would play out a few weeks ago, where the administration released a shortened version of Section 301 for one of the investigations that were taking place. I think some analysts in the market are saying that these investigations could potentially take a long time, therefore providing a window where President Trump could not be active on tariffs. I would say, given the experience from this recent investigation that was released, very quickly you will see a whole range of short-form Section 301 investigations released for all these countries, effectively replicating the tariffs. So I'm not convinced of a large market reaction or change in the overall tariff schedule 3 months out. But I think what would happen is the free hand the administration has on tariffs would potentially be more restricted. So in that sense, it would again contribute to this lower vol environment and risk positive environment we're seeing.
Hey, George, thanks for jumping on with us. Appreciate the framing. George Saravelos there of Deutsche Bank on the FX market with an interesting response to your question about the consequences or lack thereof of Friday's decision if we get one.
He doesn't think that there's going to be much market reaction at all, just simply because there'll be a cocktail of additional measures by the Trump administration to replace these. I just wonder how that's complicated by the fact that we're in midterm season and the fact that cost of living is such a significant concern.
Well, it's going to create a lot of headaches for the administration. And the Treasury Secretary has spoken about that. The president yesterday was talking about that when he was talking to the Republicans, when they were trying to really gather this support ahead of the midterm elections. But I think for financial markets, whether or not IEEPA stays or goes doesn't matter, because there will be tariffs regardless. It'll just be a 232, a 301. There's a million other sections they can go through to get the same result. It's just going to take a lot longer.
We noted this a few times at the end of last year, just how the bond market behaviour and the attitude to these tariffs, how it changed, how it viewed them in April and how it viewed them at the end of the year as some big revenue raiser that was positive for bonds, not negative.
Initially, it was thought to be a real negative. It will scare off buyers of treasuries. Now it's considered the backstop to all of the fiscal concerns. How much will it wake up to that risk, should that happen, or will it just all shrug it off?
I think that revenue's been spent 5 times already, hasn't it?
I think that we're going to get more of it.
And we're going to get checks.
Exactly.
10 different things. Yields are lower this morning. 10-year bond yields down by 3 basis points, 4.14. Up next on the programme, David Bailin of CIO Group, Henrietta Treyz of Veda Partners, Gargi Chaudhuri of BlackRock, Chris Maher of OceanFirst. The second hour of Bloomberg Surveillance, just around the corner.
You've got a lot of tailwinds coming in for growth this year.
To assume that it's clear sailing for weeks on end is probably a faulty assumption.
This is not going to be smooth sailing for 12 months of the year.
We've had plenty of recessions within the economy. It's just happened on a rolling basis.
It's going to be the jobs data that matter.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Following a 3-day winning streak on the S&P 500, a slight pullback. We're down by 0.1% on the S&P. On the Nasdaq, we're down by 0.2. Through the week, We get more and more economic data. Of course, the big one on Friday, payrolls. We get some data later this morning as well. Look out for ADP at 8:15 Eastern Time. Then at 10 o'clock, Jolson, ISM data as well. Then on Friday, we talked about this a few times already. It's not just about payrolls anymore. We're looking out for this, opinions from the Supreme Court. If we get a decision on those tariffs.
Yeah, and is it going to be market moving? We've been talking about how the bond market at one point was extraordinarily sensitive to any news on IEEPA and the potential overturning of that provision just because that was supposedly plugging a hole in the deficit. Now there's a real question. Are people just kind of blind to it or shrugging it off because ultimately those holes will be filled in other ways and it's so hard to really navigate this in any way that people just seem to ignore anything coming out of the Washington
That's
DC.
how the market feels. I know the White House definitely wants the Supreme Court to maintain IEEPA. This is definitely for the president, for him, this is a good and easy use to be able to use tariffs, really like turning on and off a light switch. You don't need to do these sort of investigations. But coming Friday, potentially we're going to get it, but we also might not. This is the funny thing with the Supreme Court. We know there's going to be an opinion day. Whether or not they rule on this remains to be seen.
Busy start to 2026. Getting some headlines right now in the media space, so let's bring them to you. This from Warner Brothers. Largely expected following our reporting in the last week. The amended Paramount offer remains, quote, inadequate, saying that the Netflix merger is superior to Paramount's amended offer.
Yeah, so now there is a question about what Paramount Skydance will come back with, especially given Larry Ellison's desire to potentially back this. Then, of course, there is a question about the regulatory overhang. What can actually get through Washington, D.C., especially if some sort of deal between Warner Brothers Discovery and Netflix does not include the news arm of Warner Brothers Discovery. So a lot of questions still swirling here. I have a feeling we're going to keep talking about this.
We are. And if it was to break up, though, that deal with Netflix, then Warner Brothers would have to pay them $4.7 billion. It's interesting you talk about the regulatory environment. The president has come out and basically said he's going to be a part of this, but he's met with both sides. Larry Ellison has been a feature of this Oval Office since Trump took the inauguration oath of January of last year. But we've also seen him at the same time speak to Netflix about this. How this can get through regulatory is going to be very interesting, but it remains clear at this moment, at least Warner Brothers wants to stick with Netflix.
Ego, I think, is at the center of a lot of this right now. Imagine you are a billionaire used to getting absolutely everything you want, and Warner Brothers come out and say, there's a lack of certainty in this offer and the ability to close it.
There is ego wrapped up in this deal. I feel like you could say that about this year. I feel like you could say that about last year. I think that there are a lot of big egos in the room. This sort of encapsulates it. A question about, is that a dare? It's not sufficient. We're worried about the risk, the debt financing that could be involved. How much does this goad people to get? Look, this is the reason why you're not seeing a bigger move right now in markets, because people are saying, all right, over to you, et tu, Brutus.
I also agree with Jonathan, though. Part of this partially is, no, I need to win this. This is a battle. The individual who is then playing off everyone's egos is David Zaslav. He is literally the man of the moment that is going to make a ton of money closing this deal.
Warner Brothers this morning down by about 0.2%. Netflix higher by 0.3. Minimal moves widely expected following some of our reporting in the last week or so. The broader equity market doing okay on the S&P 500, down by not even 0.1%. Coming up this hour, we'll catch up with David Bailin of CIO Group as investors go risk on. Henrietta Treyz of Veda Partners as President Trump looks to balance domestic and foreign policy. And Chris Maher of OceanFirst on a potential new wave of bank M&A with bank stocks at record highs with earnings just around the corner. We begin this hour with stocks hovering near fresh records on the S&P 500. CIO Group CEO David Bailin joins us now for more. David, good morning.
Good morning. Pleasure to be here.
Congratulations on the new seat, and we can talk about what the company's going to be doing in the not too distant future, but I want to take the temperature of this market with you. What are your thoughts about where we are, where we have been, and where we're going?
Yeah, I mean, it's pretty obvious that you've got a momentum on situation. You've got an earnings growth situation, earnings broadening situation. I think there are areas of the market where you're seeing even more of that. Internationally, 70% of international markets last year outperformed the U.S. U.S. investors virtually unexposed to those markets, right? Lack of diversification in their portfolio. So I like the momentum of the market. I like where it's going, but I think there are lots of areas where people need to go, whether it's in pharmaceuticals, whether it's in energy, whether it's in MLPs, where there's simply no real action on the part of investors. It's all about tech, all about big deals all the time. And I think, I think the good news is we believe that will continue. but we also think that it indicates a growing risk in portfolios.
Well, let's go to the international story. So I'm with you, and we've seen that spread to Asia in a bigger way to start the year. Is it just a different flavour of the same story, though? Just tech, but tech elsewhere?
Yeah, in part that's true, but remember that it's really an earnings story, right? It's where you're going to see, lower valuations and higher growth rates internationally, right? And you can see that in Japan, you can see that in India, right? And you can see it even in pockets of Europe and in Germany, right? As a result of the changes of the geopolitics. So you could play all of those things, but if you're an investor, you want to own that growth at a price if you can, and you can't find it at a cheap price in America anymore at all.
Just to take what you're saying a step further, are you saying that anyone who invests completely in the U.S. or more heavily in the U.S. is exposed to a concentration risk that is historic and potentially really problematic?
That is the number one thing that we're talking with clients about today, is the fact that if a client has multiple advisors, right, and they're all investing on the same thing, and they don't rebalance portfolios, and that is the number one observation that we've seen in our data this past year, is that everyone is letting these trades ride. So you have one of the riskiest stock sectors, right, semiconductors, large company, right, NVIDIA, right, leading the stock market, and it is in a highly volatile marketplace. And so we don't think there's a problem this year, fair enough. But the question is, if a person's got, that type of concentration risk, where should they move that money and when, right? And that is a 2026 move as far as we're concerned.
So you think it's international. Is it international equities? Is it in the commodity space? Where exactly do you see actual diversification against something that's really global?
Right, so you can actually do that through dividend shares in Europe in specific sectors, right? You can do it in pharmaceuticals here in the U.S. and internationally. You could do it in tech in Asia in certain areas, right, in terms of where AI is going to influence consumer markets and consumer brands. So there's lots of places where you get the growth story, but you also get diversification as to industry. Everything that we're doing is focused on where earnings are going in those places. So it's lower valuations, higher earnings growth rates, non-U.S. We're now about 20% non-U.S. in terms of our portfolios, which we can do because we're not limited to where we were when I was working in a large bank.
You also say treat cash as an asset class.
Yes.
How much should people be allocating?
So two facts that I don't think people know. The average family, right, has more than 9% of their portfolio in cash and has had it there for basically 5 to 10 years, saying they'll be opportunistic, and they never are. The average cash yield for that family is 2.7%. They could be earning 4% in treasuries. They could be earning 5% if they have a blended portfolio. And one of the reasons why that's true is that they have their cash in 15 different accounts. None of it's aggregated and it's not managed. So why is that the case? It's largely because it's a little bit everywhere. And so that's an enormous opportunity. If you have 9% of your portfolio and you can make an extra 150 basis points in it, right, you should be doing that. And these are the observations that we're now able to see, because when you look across all of the accounts that a family has, you can actually just see how it is that they are really undermanaging certain assets. And that's why we call cash as an asset class, because it's a large portion of the portfolio and it's largely undermanaged.
You're laying the foundations for a broader conversation about what you're doing now. How much extra insight do you have now versus what you had previously? And would you go as far as saying that this industry is letting some of those families down?
I would actually go far as to say that I really didn't think that a year ago, right? But it's not only, it's a structural issue, because if they can't see the assets, theoretically they can't comment on them. But what's really interesting to me is that the industry is charging an enormous amount in fees for the advice that they get. So the average family is probably paying 1.4% if you add up the cost of the funds they own and the cost of their advice, right? Which in a 15% year is 9% of what they actually made, right? And yet, right, they're basically index oriented. They're getting all of this exposure without getting diversification, and they're getting, not very good yields on their cash. So I would just say that they're not getting the implementation of the advice that they should about following the basic rules of finance, which is diversification and meaning it. And that's what I would say. Yes, that's true.
At a time when there's so much focus on wealth management at big banks, why do you think this is? Is it just groupthink, or is it that there are certain incentives to be invested in certain areas?
I just simply think that the industry is going under such an amount of consolidation right now. RIA roll-ups, banks basically buying other, wealth management institutions, consolidation in asset management. It's an extremely profitable time for the industry, right? So there's no real reason to take a look at the very nature of its fee structure, given all of that, right? If you think about it, right, clients can get... I'll give you an example. If you take our asset allocation and you actually look at the cost of the funds that we use, it's 18 basis points to actually buy all of the ETFs in the United States that we like, with extraordinary specificity as to what individual sectors you want to get exposure to. If you want to get exposure to ETFs in MLPs right now, which we're doing, or in pharma, right, or in biotechnology, you can literally buy those at very inexpensive things. So you can assemble a portfolio that way, or you can pay for active management at 60 or 70 basis points and not get any benefit from it, right? Well, the industry is largely stuck on the way that it's done it. It has no incentive to change.
David, just before you go, is there a wealth bracket in particular that you think is vulnerable to some of the issues you just explained?
Yes, it's a very wide bracket. But if a family has, $10 to $500 million, and they're using multiple advisors, which is a huge amount of wealth and extraordinary, right? But if they've got $10 to $500 million, right, and they're using multiple advisors, the probability that they're beating the markets or that they actually have their money adequately and diversified and invested is extremely low.
What happens 500 and up?
They tend to get more advice by having an individual inside the family who is actually coordinating the professional activities. And interesting is they actually have goals and an IPS that they're following and are being checked on. It's when they don't have that and they're relying on multiple providers that they end up not having a sense of direction.
Things I'll never have to worry about, but a good conversation.
That's not the case. We actually have studied you, and you're going to be fine.
I'm going to be all right.
You'll be right in that group of people not getting good advice.
I appreciate it. Thank you.
I tell you.
It's just I'm not in the 10 to 500, Bramo.
No, I know, but that SPAC, we're going to come up with a SPAC, and then you'll be right there.
No.
You missed
it's
the punchline.
Greenland company.
That's right.
If you're in the 0 to 10, you're not being taken advantage of, Lisa.
Okay,
so
great.
There you go. All right. David, good to see you. Smart
We're
stuff.
safe.
My pleasure. Thank you
Appreciate
so
it.
much. Appreciate it. You bet.
David Bailin, the CIO Group CEO. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Here's Yahara Anand with more. Hey, Yahara.
Hi, John. Warner Brothers Discovery saying an amended takeover offer from Paramount Skydance is inferior to the deal it already has with Netflix. The board of directors writing in a letter to shareholders, Paramount's offer provides insufficient value and it doubts the company can close the deal despite a personal financial guarantee from billionaire Larry Ellison. Meanwhile, Universal Music is partnering with NVIDIA to expand the role of AI in music discovery and creation. The partnership will focus on using AI to improve how fans discover music and engage with artists. The companies also plan to build on NVIDIA's audio language model, Music Flamingo. And in sports, the Baltimore Ravens firing head coach Jim Harbaugh after 18 seasons with the team. The move follows a disappointing season for the Ravens where they failed to make the playoffs despite Super Bowl aspirations. Harbaugh was the second longest tenured head coach in the league, winning his sole Super Bowl with the team back in 2012. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. I'm next on the program, reclaiming the domestic agenda.
Let the money go directly to the people where they can buy their own health care. If you can do that, this is going to be your issue. I'm going to meet with the insurance companies.
That conversation up next with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. We're down by not even 0.1% on the S&P, on the Nasdaq 100 down by 0.2. On a Russell, a little bit softer also. About an hour from now, we will have some ADP jobs data for you in focus at 8:15 Eastern Time before we see the payrolls report this Friday. The estimate in our survey is 50K. The previous number, Lisa, negative 32.
Yeah, you could see a potential recovery. And this is actually the potential bull case that some people are looking at, not only in ADP, but also as a predecessor to what we could see on Friday. What if you get a rebound, right? What does that do in terms of risk on, risk off, given the fact that people have seen the weakness at the end of last year and said, this is the reason why this Fed can cut rates?
Then you've got a better story to tell. Tax refunds, spending picks up, a better economy. We hope that's the direction of travel.
Which is the reason why stocks are betting on it and bonds are betting that that's not going to happen. So one of them has to be right, one of them has to be wrong, and I guess we'll get the answer.
The White House also hoping that's the direction of travel. Under surveillance this morning, reclaiming the domestic agenda.
Let the money go not to the big fat cats in the insurance companies that made 1,700% over the last short period of time. Let the money go directly to the people where they can buy their own health care. If you can do that, you're going to have, this is going to be your issue. You know, I'm going to meet with the insurance companies. I said, I'm going to meet with them. I'm meeting with them all, 14 companies.
So here's the latest this morning. President Donald Trump pushing House Republicans to own the healthcare issue ahead of the midterms as voters show they are more concerned with affordability than foreign affairs. Jonathan Tamari of Bloomberg Government joins us now from Washington for more. Jonathan, that's at the top of the agenda for Americans in this country. How are they going to speak to that? What are they going to do in the year ahead?
That's the really big question. One of the challenges for Republicans is that they haven't laid out a clear affordability agenda. You know, the president is talking about trying to lower gas prices. He's made this kind of targeted pitch on health care, but these things are going to be really hard to happen quickly. Right now, there are millions of Americans who are paying higher premiums through the Affordable Care Act because some subsidies expired under Republicans' watch this past year. And so it's a major challenge, and they have a very narrow majority in the House, so it's going to be hard to get any major legislation passed this year.
Jonathan, we talked about the pitch that's going to come from Republicans. It's going to be the tax refunds, and hopefully the economy picks up going into the middle of the year. What's the pitch from the Democrats? What are they offering up going into midterms?
So they've yet to lay out their own affirmative agenda, which is a big challenge for them. It's something they've really struggled with during the Trump years. Right now, they're basically saying Trump promised you that he was going to lower prices, lower inflation, and that his focus has been elsewhere, that his focus has been on Venezuela, on immigration, on all these other things, and not on lowering prices the way he promised. As far as an affirmative Democratic agenda, we're still honestly waiting for that outside of the healthcare space.
Jonathan Tamari down in Washington. Jonathan, thank you. Appreciate you making some time for us this morning. To build on this conversation, Henrietta Treyz of Veda Partners joins us now for more. Henrietta, Happy New Year and a welcome to the programme, a warm welcome. What's at the top of the agenda, do you think, for Republicans? What's achievable in the months ahead?
Well, with a one-seat majority, you have almost nothing that's achievable, and that's the state of play for Speaker Johnson right now. So when President Trump spoke to the conference yesterday, he laid out a whole host of things that Republicans would like to see. But the bottom line is this is where an understanding and being, a legislative wonk is really helpful. You just don't have the votes. So talking about reorganizing healthcare is not an option. The best that they could do is extend the ACA subsidies that expired at the end of the last year. 24 million people, some people paying $1,000 more in ACA subsidies. That's going to be the bulk of it. And the real news from that event yesterday was around the Hyde Amendment, which is related to abortion. We're on the same old issues we've been focused on for 16 years. So expecting radical change on the healthcare front is just unrealistic.
Henry, is there appetite within the Republican conference to expand those healthcare subsidies?
I think there's appetite to extend, definitely not to expand. So they put, wage requirements on there, duration requirements on there. It wouldn't be open-ended. The duration is anywhere between 6 months to 3 years. There's even a 5-year bill, but expansion is not on the table. And so that's sort of the best that they can hope for going into this.
So does this mean we will not have a government shutdown at the end of the month?
I don't think we're going to shut it down. I think Democrats feel like they proved their point. They got the narrative in the United States around the voting demographics to focus on affordability. And as y'all were just pointing out, they don't need a proactive agenda in their view. They just have to keep the conversation on affordability and housing in particular. And so that's where Schumer and Hakeem Jeffries are going to focus the narrative as they go out into the campaign trail. And, obviously the president is very concerned, as he has been throughout all of last year, with maintaining control of the House. But now even the Senate is slightly at play for the Democratic conference. And that issue of affordability is paramount, as you were just pointing out.
Well, the president yesterday said this, quote, "I wish you could explain to me what the hell's going on with the mind of the public." Henrietta, when it comes to the president and his pitch to the American people, when it comes to affordability, he has gotten gas prices lower, but grocery prices are higher. He has stopped the inflow of immigration at the border, something he pitched the American people. But at the same time, right now, he's taking a very aggressive foreign policy posture. Is this something Americans want to sign up for when it comes to the midterm elections?
Such an exceptional statement to seize on. The president's commentary shows that there is, honestly, kind of gaslighting going on within the White House. And I would start with the tariffs. The tariffs are widely understood by the American public. Everybody watched the news on Liberation Day, and every small business that's importing anything, whether it's a children's toy or a refrigerator, is focused on what happens next. What happens at the Supreme Court? Do I need to pay this harmonized tariff schedule number? What's my tariff rate? Every single person in the United States is concerned about tariffs, and they do not like them. This is a rare example where Trump is at a 60-40, sometimes even 70-30 deficit with the American public. He likes the tariffs. America does not. And so when he says, what's going on, it's the tariffs. The foreign policy thing is actually very consistent with what we've seen from Americans for generations now. They just do not care. 4% of Americans think that the drug trade in Latin America is worth prioritizing. They just don't care. Bring the prices down. Nothing else matters.
Henrietta, what does that mean in terms of if the Supreme Court does strike down tariffs under the IEEPA Act, whether the president will be willing to go forward on a cocktail of additional tariffs and put them on, given that they are so unpopular?
There's a disparate view in D.C. If you are a trade policy person, you are looking at the tariff laws and the code and say, what can I do? Can I migrate to a balance of payments authority and collect 15% tariffs for the next 150 days? Sure, you can totally do that. That is reasonable to physically do. But think about it from the perspective of the manufacturing base or any importer or business or American voter. You now have to go through Liberation Day all over again. You have to figure out what tariff schedule you're exposed to, what the rate's going to be, how long it's going to be there for, whether it will come back. If they use 338, that's never been used before in history. We're going to go through this whole rigmarole where it goes to the Court of International Trade, the Court of Appeals, and the Supreme Court all over again. So it's that uncertainty, which was the buzzword of all of 2025, that will come rushing back. And my view is the president has to take that into consideration, especially now that we're 11 months away from a midterm election cycle where Republicans are about to get shellacked with a D+4 generic ballot situation.
Henrietta, can we just finish on one thing, just take a step back? Why is everyone in Washington so bad at handling this issue? We torched the Biden administration, quite rightly, when they were talking about prices. Inflation was heading towards double digits, and they were like, there's nothing to see here, everything's fine, it's a great economy. It certainly wasn't for many people. Unfortunately for the president, he now owns the issue. He's the president of the United States, and the Republicans control Congress. They own the issue too. Why are we seeing successive governments perform so poorly on such a key issue for the American public?
I think the inflation memory bank is really strong. We're still in the mindset of the post-pandemic era. That's sort of what the data suggests. I would point out the idea that you can't follow the University of Michigan consumer pricing consumer sentiment index anymore. It's because now all of your views of the economy are shaped by your politics. So if you like Trump, you think the economy is great. If you don't like Trump, you don't like the economy. And now we have this mix-up between understanding your own personal finances, the state of the U.S. economy, and whether you like the person in charge. It's just a polarized United States economy, and it's seeped into everything.
It's going to be a long year. Henrietta Treyz there of Veda Partners. Henrietta, thank you. Thank you very much. It's a key issue. It's the number one issue in this country, and politicians just seem to struggle to deal with it.
I had this discussion last night at the dinner table with the kids. Do you experience prices going up? And they said, oh, my God, the vending machine, you should see that vitamin water. I mean, really, but the fact that it's so present, it was just sort of interesting.
Well, it's really also, I think, hard for politicians to explain to the American public, we have no control. Well, I wouldn't say no control because they have rewind some tariffs because they are concerned. But the price level is set. They can potentially try to help when it comes to the increase of the rate going up. And that's very difficult to explain.
They've inherited a much, much higher price level, and it's a problem and remains a problem. Coming up on the programme, Gargi Chaudhuri of BlackRock seeing more momentum in the AI trade. Plus, Danny has your morning movers, taking a look at GameStop in just a moment. That stock higher by 2.5%. The oven about 2 hours away. We're pulling back just a touch. We're down by 0.1% on the S&P following a 3-day winning streak. On the Nasdaq 100, we're down by 0.2. In the bond market, a rally this morning over the last few hours. Yields down across the curve. 2s out to 30s. We're down about 3 or 4 basis points. On 10s, back to 414.36. Check out Europe. Euro dollar not doing much, but the data this morning interesting. Core CPI for the Eurozone coming in just a little bit softer than expected, maybe opening the door to a conversation at least about lower interest rates to start the year.
Yeah, or at least that the next move isn't going to be a rate hike, right? This was sort of the fear for the ECB. But the idea that you have in check inflation in the Euro region really opening the door to the idea that isn't going to be the inflationary source that could potentially push yields higher, maybe giving a little bit of fuel to this rally.
Euro dollar 116.86. You've got to wait until early February for the ECB decision, but Christine Lagarde, the president, talks so much, I imagine you'll hear from her very soon.
Yeah, and probably you'll hear that they're in a balanced position and they're not going to do anything. And right now the market will just continue to say, la, 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 la.
Getting bored of ECB news conferences? Is that
No,
what you're trying to say?
I always love them.
OK. Tune in to the next one in early February. As we count you down to the opening bell, let's get you some morning movers. Danny Berger has more. Hey, Danny.
Hey, John, I want to check in some of the companies involved in the Warner Brothers Discovery deal. Not a whole lot of movement despite an announcement about 30 minutes ago that Warner Brothers Discovery still sees the Netflix deal as the best one on the table and the Paramount one as inadequate. Behind it, they say, is the structure of it. $50 billion of debt would make it one of the largest, if not the largest leverage buyout, which they say will make it difficult to get across the finishing line. Warner Brothers a little bit weaker, Netflix up 0.5%, and Paramount unchanged this morning. Elsewhere, GameStop, those shares are up nearly 3%, announcing a new stock award compensation plan for the CEO, Ryan Cohen. He doesn't get a salary, he doesn't get a bonus, so this would be his only pay if he hits very ambitious targets, including an $100 billion valuation market cap for the company, 10 in earnings or in profit rather. So investors excited that, hey, if he can get there, that's a good thing for the company. Finally, rounding things off with a Wall Street Journal scoop that Eli Lilly will be buying Ventyx Biosciences. It's a biotech company that makes inflammatory disease medicines. It would be for around $1 billion. The current valuation of Ventyx is $500 million, so it's a significant premium. John.
Danny, thank you. Appreciate it. Thank you very much. On our radar this morning, NVIDIA is stepping up production of its H200 chips for the Chinese market as the company awaits export approvals from the White House. The CEO, Jensen Huang, saying demand for the chips is, quote, very high. The stock is up by 0.6%. Elsewhere, the Energy Secretary, Chris Wright, meeting with oil executives today to talk about reviving Venezuela's energy sector. President Trump reportedly holding his own meeting with the CEOs on Friday to discuss plans to drill in the country. And finally, the Supreme Court set to release opinions on Friday. The Trump administration awaiting a decision on its global tariffs. A ruling against the levies would undercut the president's signature economic policy and could force the U.S. to issue refunds to importers.
We already heard about some companies, Costco in particular, that was preparing and laying the legal groundwork to potentially recoup some of that money. You have to think that other companies have done the same. Real question, does the market respond? Let's say this is announced on Friday, which it might not be, and let's say it is an overturning of the IEEPA Act used as justification. What happens? Is it the bond market that gets roiled? Is it nothing? Does everybody just assume that things are status quo? That, to me, is going to be a really interesting tell.
Well, George Saravelos says, at least when it comes to the dollar, it's going to be status quo. They look through this because they are reminded that the president does have other use cases he can use. Section 122, never used before, but the president can use that. 201, 338, 301, 232s. He can go through the Commerce Department or USTR to figure out a way to enact tariffs. The key issue, though, politically is going to be, can this all be done in time before the midterm elections?
It might make it more volatile and not less, because you're going to see a lot of announcements to try and correct course.
You know, if you get those announcements, I really like the idea of starting at ground zero. Think about if you're a producer. Think about if you're an importer. Think about if you're a retailer. Suddenly, what do you do with this? Especially because this was the time when people were going to pass along price increases because their inventories are done. So all of a sudden, you get the direct pass through and, frankly, ongoing uncertainty and
You want to
confusion.
start at ground zero again. I was there in April at the Rose Garden ceremony when everyone thought the president was done, but then he came out with that huge billboard and had all the rates. And then from then on, I was waking up in the middle of the night because there was new trade tariff threats to another country. So I'm glad, you can start going down there.
I remember you messaged me the picture of that, and I just looked at these numbers coming up. I was like, what is this?
And you go, tweet that. You need to tweet that immediately.
Like,
no one sees this yet. I was like, he's about to hold up the billboard.
Yeah, the market started rallying, thinking it was just going to be, what, a baseline 10%, and we'd move on.
And then all of a sudden, it was,
Crazy.
the Penguins.
What a crazy time. Yes, that. And then the market didn't care anyway.
Right, exactly.
Middle of April, we just ripped and never looked back.
It was just going to happen some other time.
Then the pass-through didn't happen either on inflation, in a
this,
big way anyway.
Right, but this is actually the interesting thing. The inventories absorbed a lot of that. Now those inventories are up. So this is the question. Are any new tariffs going to be felt much more directly and potentially prevented by some cost of living concerns?
We'll build on all of this in just a moment. Let's turn back to markets. Gargi Chaudhuri of BlackRock sees one dominant theme, writing AI remains our top equity investment theme as we believe the market continues to underappreciate the opportunity of the data center build-out. Gargi joins us now for more. Gargi, good morning. Happy New Year.
Hi, Happy New Year. Good morning.
Good to see you. Let's get to that second line. I want to put that quote up again. Because I'm just sitting here thinking, underappreciating the data center build-out. This market's absolutely ripped on AI themes. What are you getting at?
Well, it has ripped on AI themes broadly, but we've also, if you look at valuations from the start of 2025 to the end of 2025, our basket of AI stocks has actually cheapened over the course of the year. So earnings growth came out as really, really solid, as a result of which, obviously, your PE got lower. So the underappreciation, I suppose, is just the recognition that every single quarter, and again, it might not happen this quarter, but over the course of 2026, we're probably going to once again surprise on earnings growth. Now, what we also go on to say in that outlook, beyond AI, is that this is the first time in a few years that we're finding opportunities outside of AI as well. So active in AI, but look across the market, and we specifically talk about value, and then we talk about international as well, as other opportunities that are likely to do well also.
Well, let's start with AI.
Okay.
The AI trade now, what is it in 26 compared to what it was in 24, 23, 25?
Absolutely. So we actually had a client call because we released this outlook yesterday, and what our clients think, and I thought it was really interesting to share, is they have the AI trade, but they want to diversify within it. They don't want to diversify away from it. So they have the S&P or other forms of AI, semiconductors, for example. They want to diversify within it. So what that could look like, and we're beginning to see some of that already, is AI in Asia. So we're beginning to see that in Asian markets, in Korea and Taiwan. Could that be the next leg of the AI trade, where you're getting less of the cloud software enterprise and you're getting more of that chip manufacturing? So that could be one theme. And then obviously broadly, selectivity in AI we think remains key. Look, even last year, you had, again, looking at our basket of 40-ish AI stocks, about many of them ended the year lower. So that picking the right part of the value chain in AI is going to be very crucial. But it remains a theme. It's going to be driving other parts of the market, which is why we're going on to own more than AI. It's not just the only theme in town anymore.
It seems like a rolling ball of money. And it has sort of been focused on a couple of names in artificial intelligence, and people are looking to roll into other areas. Mm-hmm. Memory in particular, absolutely flying. SanDisk, I know you're not going to talk about specific companies. Is this something that can persist, or is this just specific fads that are cycling through different parts of the ecosystem?
It might feel like it's cycling through, and when we look at the market every single day, which our jobs are to do that, I think it'll feel like it's cycling through. But if we come back 1 year later and I come to this show again, I think over the course of the year, the AI theme will have returned us meaningfully, and certain parts might have done better than others, but the AI theme will still be something that we're talking about. But the one difference, I think, next year or this year will be that we will also be talking about other parts of the market. I think value is a part of the market that is going to, at least for the next couple of earnings seasons, show a big pickup in earnings growth, and that'll drive performance. We've already seen that. So we're talking a little bit about tickers like BLCR, which gives you access to rest of the market, not just the top sort of AI theme names.
How much is that predicated on the Fed cutting rates, on potential fiscal expansion, on this idea that this AI build out isn't going to be inflationary?
If you look at the market performance, even in the first few days of the year, I think the sort of the rotation, if you will, that we're seeing into some of the other parts of the market is very much related to things like the Fed, things like expectation of more, not less from the Fed, especially if we are to believe that oil prices in the future, because of supply, can be lower, that takes away some of the pressure from headline inflation. All of that is driving the cyclicals to vastly outperform other parts of the market. And I think to the extent that we believe, and this is something that we write about, is that growth is going to be higher than potential. Rates are going to be lower than what many expect. I think that absolutely gives tailwinds to the equity market, and certain parts of the equity market, like cyclicals, can benefit from that.
When it comes to the AI data center build out, yesterday Jensen Huang sat down with Ed Ludlow and was asked about the energy factor in all this and the anxiety around that. And Jensen Huang said there's never enough energy, and anytime you're on the cusp of this kind of industrial revolution, you are always in need of more energy. How do you think about that gap right now?
Yeah, obviously that's something that we're thinking about a lot, and I also think that focusing on the next leg, and Lisa, to your point earlier, are clients now going to? Is there going to be fads? So is the next trend in power and energy, and that could certainly be the case. We've seen the trend in cloud and software, and then we've obviously this today and yesterday we've seen it in chips and all of last year. Is power going to be the next theme, so as to say? Is that the diversification within the AI theme? I think so. It could be.
But is there enough out there?
I mean, this is where financial innovation comes into play. It's obviously a concern, but I think that hopefully we'll find ways with financial innovation to be able to navigate this.
Gargi, good to see you. Thanks for being here.
Good to be here.
And once again, Happy New Year. Gargi Chaudhuri there of BlackRock. You mentioned SanDisk. The move in SanDisk, just ridiculous to start the year.
Okay. Yesterday, this is one day, 28%, right? That's the best performance since February. But it's been what? It's gained something like 160% in just so far the first trading days. There is this focus on memory because Jensen Huang himself at CES said, this is the key sticking point for us. Yes, it's energy, but it's memory. Because guess what? You need to remember all those facts and put them together and then give you some sort of cohesive answer on ChatGPT.
Great work from Ed, once again, in the last 24 hours. Fantastic. Let's give an update on stories worldwide and elsewhere with your Bloomberg Brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. China is ramping up its e-commerce restrictions, unveiling regulations that ban major platforms from coercing online merchants into promotions. The move is one of several new measures aimed at cooling growing e-commerce competition. The guidelines take effect February. Alibaba shares dipped on the announcement in Hong Kong trade. Meanwhile, chat app company Discord filing confidentially for an IPO. Sources telling us here at Bloomberg the app is working with Goldman Sachs and JPMorgan on a listing. Discord, which is popular with gamers, offers voice, video, and text chatting capabilities and has more than 200 million monthly users. And the Trump administration is expected to advise Americans cut down on their sugar intake. Sources telling us here at Bloomberg new dietary guidelines will urge people to eat no more than 10 grams of added sugars per meal. They are also expected to tell Americans to shun highly processed foods. The new guidelines are set to be unveiled later this week. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. Do we need to be told that? Is that what we need to be told?
Evidently.
Less sugar and processed foods?
So if you're going to have banana ketchup, reduce the sugar.
Getting at that food we were talking about yesterday. You're offending Italians again. What's it called? Sweet spaghetti.
Sweet spaghetti. Yeah. So you're offended because clearly this is what you have in your home.
Yes, often. Really. Up next on the programme, Mum's over at the moment.
Oh, really?
Yeah.
Oh, so she's watching something.
No sweet spaghetti.
She's going to come home and she's going to say, honestly, good for you.
Ferro right
Mrs.
now.
Ferro, I think you're doing wonderfully. Good job.
Good save. Up next on the programme, a big year for M&A.
2026 is going to be the year of big. We're going to do deals to cut costs. I think they're going to use this as sort of a, once in a generation opportunity to redeploy capital in a very specific strategic way.
That conversation up next with the OceanFirst Bank Chair and CEO, Chris Maher. Stocks going absolutely nowhere on the S&P 500, pretty much unchanged. We're down about 0.2% on the Nasdaq 100, on the Russell, softer by just 0.1%. Under Saravelos this morning, a big year for M&A.
2026 is going to be the year of big. You could have banks and other companies across the space really thinking about where their strategic holes are. We're going to do deals to cut costs. I think they're going to use this as sort of a, once in a generation opportunity
to redeploy capital in a very specific strategic way.
So here's the latest this morning. Wall Street anticipating another wave of bank M&A after seeing a surge in deal activity last year. Chris Maher, the chairman and CEO of OceanFirst Bank, writing the following: institutions are pursuing deals with the goal of building greater scale, expanding into growth markets and establishing more competitive regional platforms. Chris joins us now for more. Chris, good morning.
Great to see you, John.
Great to see you, sir. Let's get straight into it. Let's talk about what they haven't been doing, what some of these companies you serve are not doing, which is hiring.
Absolutely.
We've seen this kind of jobless growth over the last year, if we can call it that. Walk us through the companies you serve, the regions, and whether that story is going to change at all.
Yeah, so we serve a wide variety of businesses all over from Washington, D.C. through Boston, mostly New York, Philadelphia, New Jersey, and all sorts of industries. And what we're seeing is they're just not leaning into hiring, not bringing on new folks. If they are, they're bringing on kind of new young folks who have kind of native skills around AI and machine learning. They're much more likely to make capital investments, which is good for a bank. We get to finance that, but not a lot of hiring, a lot of just caution. Concern.
What do you think speaks to that? They're not sitting on their hands. They're deploying capital. They're making big decisions. We've talked about the M&A.
Yeah.
What speaks to the lack of hiring?
I think what they're seeing is their businesses are doing well without a need for hiring. So they're seeing growth. They're seeing opportunities, backlogs increasing. So there are some segments, obviously construction, the stuff, the real economy, where you've got to get the hiring done. But for the most part, you don't need that to grow revenue.
How much is this really concentrated in the larger companies that you serve? And I wonder, after Cameron Dawson was on and she was saying essentially a lot of the big companies are already monopolistic or oligarchies kind of in their field, and they can create these efficiencies of scale and just pass along slight increases. Is that kind of what you see as well?
Absolutely. Lisa, you're exactly right. The larger you get, the bigger your scale becomes. The more the economies of scale matter in things like the back office. So I'll use our bank as an example. We've reduced our back office headcount by a third in the last 2 years. And doing the same things, keeping our customers happy, customer satisfaction's higher, but we're just able to do more with less. So we're focusing our hiring on the front office, customer relationships, revenue focusing folks.
How much does this sort of redouble the emphasis then on growth, on whether growth organically or growth by acquisition?
Yeah, well, they're both important. We've been focused on organic growth over the last 5 years. Grown the bank about 45% since COVID hit. So, very pleased with that organically. But this is an opportunity where M&A can make a difference as well. So when you compare M&A that complements your organic strategy, I think that's a real win.
When you say that you're, getting rid of some jobs in the back office, moving them to the front office, do you then think that AI will not be the ultimate replacer of jobs? There will still be work in the future?
Annmarie, when you think about growth, if you're growing, I think you're able to grow into the new economy, and you're going to have the same amount of jobs, maybe deployed a little bit differently. But that's why growth is so critical. If you're not growing, you're not going to have the opportunity to redeploy the resources around the company.
You mentioned M&A. So what are you expecting for this year? Because a lot of people thought we were going to see really robust mergers and acquisitions under the first year of the Trump administration.
Well, I think it takes a little while for things to settle out, for people to understand the new kind of rules of the road. There's been a lot better transparency, I think, around what those rules are. We stepped back in. We took about a 5-year hiatus from bank M&A, but just last week announced our first deal in 5 years. And partially we did that to complement our organic growth strategy here in New York, but also because we knew the risk would be lower because we got better transparency about how that approval process will flow. The time to get it done will be faster, so the certainty around execution is just a lot better.
Is that another way of saying the politics changed?
That's a very good way to put it, John. But the rules have changed, the transparency has changed, and the predictability. If you went back a couple of years ago, it was not unusual for a bank M&A deal to take more than a year to get approved. And that year is a tremendously expensive time. You suffer the risk of distraction, other things happening. So, we're looking forward to the better transparency, better execution, ability to do it faster.
You're not alone. We've seen a lot of bank mergers and just mergers in general. I'm just wondering, we've talked before about how there are thousands of regional banks in this country, and that could get whittled down to about half the number as it has been over the past few years. Do you foresee that type of wave of M&A coming? Is that the kind of activity that you expect?
Lisa, it'll be slow and steady. You'll see it over the next few years. I don't think we're going to cut the number of banks in half. But they will come down. I think we're going to get more competitive regional banks. I think that's great for our economy. We need more large banks to have a little more competition at that end of the spectrum. We're also seeing something really interesting. De novo banks are back. That's a big change under this administration. So they're welcoming de novo banks. You're seeing new banks being chartered for the first time in years. And that's a net positive.
Chris, are you looking outside the regions you're operating in?
I'm sorry?
Are you looking outside of the regions you're operating in?
No, we're really fortunate. We operate here in the Northeast, which is the deepest banking market in the U.S. So we can grow here for many, many years and stay right here in the Northeast.
Because you talked about the need to get bigger.
Yeah.
Can you achieve that scale in the Northeast?
Oh, absolutely. When we think about like our market share in New York is still in the 1% range. I think we can move it up a great deal.
Chris, it's good to see you.
Good to see you, John.
Thanks for being here. We appreciate it. Chris Maher, the OceanFirst Bank Chairman and CEO, on some of the M&A activity. They've been a part of that. And the M&A activity we could see in the year ahead, given the politics shift and the greater transparency.
Yeah, the greater transparency.
A more diplomatic way of putting things.
Well, yeah, that basically this administration has reduced a lot of the regulations and has given a green light to a lot of the consolidation. The other point, about a third of the back office no longer being necessary with the same amount of work coming out in productivity. It raises this issue: what parts of the workforce are going to be rendered obsolete, and what parts of the workforce are a lot of companies going to lean into even as they look for economies of scale? That is going to be a real focus.
And if that is an issue, say we do see higher unemployment because of AI, how does the Fed address that? No one has been able to answer that question. It's incredibly challenging. Are we on the cusp of potentially needing less jobs? And potentially we'll get more insight into that as well.
Sounds like a massive political problem, not just for the Federal Reserve, but for whoever's in power down in Washington, D.C. I don't know how you navigate that. Can't just keep pointing to GDP and saying growth is fine if hiring is slow. That's going to hurt you when it comes to voting time.
Yeah, when you have the likes of Bernie Sanders cozying up with a number of Republicans.
Steve Bannon.
Exactly. Then you start thinking, okay, this is increasingly a political issue, and it goes to the energy costs as well. You have seen energy in specific areas get much more expensive at the same time that jobs aren't being created. How does this sort of percolate out into some sort of restriction around AI? And this is actually one thing that people are talking about. How much regulatory risk is there around maybe constraining some of this growth in D.C.?
And Donald Trump and individuals like David Sachs, they really want to own this AI trade in the United States. Steve Bannon has said you got to be careful when you do that, not just because of jobs and electricity. Look at the unemployment rate right now of college grads. They are struggling to find jobs. And how much of this is potentially there's a mismatch, or is this really AI?
At the moment, it's not a market problem. The market's getting the best of both worlds. Earnings are decent. You get the low rates as well to adjust to what's happening in the labour market. But at some point, you talked about the younger generation, how they're voting. That's going to have consequences ultimately for financial markets in the not too distant future. If they carry on voting in the kind of people that voted in right here in New York City.
That definitely will become a political issue. Before that, last night I was actually wondering which jobs are getting disrupted most. I'm thinking call centers. That must be absolutely obliterated. And you look up, a lot of the call centers were customer service, full suite of things. You don't need to have an AI bot. It was sort of interesting to see that, not necessarily reflected.
More still to come. Up next on the programme, John Bilton of JPMorgan Asset Management, Tony Wang of T. Rowe Price, Kathy Bostjancic of Nationwide, and David Rubenstein of Carlyle. The third hour of Bloomberg Surveillance up next.
There should be some broadening out, but we are not ready to bet against tech.
The hyperscalers are going to drive more and more of the outcomes.
I am kind of keen on the impressive 493. Everybody's focusing on the magnificent 7.
The majority of these companies have very, very robust cash flow.
Investors have really gotten bulled up on is a very strong economy in 2026.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. The opening bell about 90 minutes away, and your scores look like this. Equity futures on the S&P 500 down by not even 0.1%, pulling back by a quarter on the Nasdaq 100. Lots to look forward to this week. Tons of economic data. Payrolls on Friday. The ADP jobs report about 14 minutes away, setting the tone for jobs later this week.
Yeah, do we get an increase of 50,000 jobs in that ADP print? And what does that mean for what we get on Friday? Currently, the average among estimates compiled by Bloomberg is 65,000 for the change in non-farm payrolls at the end of this week. Okay, let's say we get that right. Do we understand what that means in terms of the break-even rate and what that means for unemployment unemployment? I certainly don't. So it's sort of like the Rorschach test continues, where you can get the number, and what does that actually mean?
I don't either, but I'd like to see a bounce. I think we all would.
100%.
Right? And we might get a bounce in a moment. We're looking for 50K on the ADP employment change when that number drops at 8:15 Eastern Time.
Well, also, thinking about what this means for the Federal Reserve and the unemployment number coming out on Friday, Citi just put this at holding pattern. Many Fed officials see policy rates as now having entered the range of neutral. Maybe less urgency to rescue policy rates. Does this potentially mean if the labor market holds up, this is going to push what some people are thinking 2-3 rate cuts way down the timeline? And the reason why I care about the timeline is because this is an election year and it's a key midterm election year.
If the labour market stabilises, and that's good news. If you're in the business of politics, you want the labour market to stabilise, hiring to pick up. Andrew Hoddenhorst of Citi's not expecting that. He's looking for unemployment to carry on that drift towards 5%. That's a problem.
Yeah, and he's not alone with that. This is also someone, Andrew Hoddenhorst does expect them to cut rates in their January 28th meeting. So later this month, he does expect the beginning of a series of rate cuts. This is the issue that people have. The labor market is an enigma right now. People don't understand how much it's AI-related job losses, how much companies just are looking for reasons not to hire, how much we are in a massive transition time where it is important to run the economy a little bit hot so there can be that growth to prevent unemployment rates from getting incredibly high.
We'll get some jobs data in just a moment. Coming up this hour, we'll catch up with John Bilton of JPMorgan Asset Management as stocks are trading near all-time highs. Tony Wang of T. Rowe Price as the race for AI dominance is expanding. And Kathy Bostjancic of Nationwide with investors preparing for a fresh read on the labour market. We begin this hour with stocks stalling following the first record close of the year. John Bilton of JPMorgan Asset Management writing, given our expectation of a moderate pickup in the pace of growth in 26, we see potential for positive equity returns. John joins us now for more. John, good morning.
Good morning.
It's good to see you. We've been flattered. We've been blessed by some really, really decent double-digit gains on the S&P 500. Is there more to come?
Well, I think if you believe that the economy is in a decent place, you believe we're going to get fiscal stimulus coming through this year, we see unemployment, behaving itself per your earlier comments just now, if we see the impact, which is always delayed, of the Fed cuts coming through and actually supporting the economy, which we think they will, then if you look back through history, 9 times out of 10 in a year with no recession, and we're not calling for a recession, we think the odds are pretty low, then the S&P delivers positive total returns. So sure, if you want to bet against stocks, go crazy, but the odds are not your way.
Skate to where the puck is going. Where do I want to be now, already, to take advantage of some of this?
Well, we think that what we're going to be seeing this year is, a little bit more in terms of the continuation from some of the themes last year. Things like that gradual weakening of the dollar, which is going to flatter some of the international markets. Of course, if we look at what happened with Europe, with the US, the indices in terms of their returns in local currency were not too dissimilar. But you got a big boost as a US dollar investor if you were beginning to be a bit more adventurous and look outside. We've obviously got that AI trade, which continues. We think it's important in the US, but remember, it's a concentrated piece of the market. People want to be able to find a different way to invest. Asia looks pretty good there. Some of the impact in terms of the investments that have been made in the last few years start to bear fruit? Does it broaden out across the economy? I think that's the sort of themes that folks are looking for this year, trying to put a few more eggs in a few different baskets.
I was going to ask, how adventurous do you want to get? Samsung or Venezuela bonds?
I think we... well, there's a few themes there, aren't there? I mean, one of the other things which I think is supportive of the economy generally is this emphasis on oil prices coming down, right? So anything which is freeing up supply, potentially being a bit of a sort of downward pressure on oil prices, ultimately is good for the consumer. That's ultimately good in the US. It's supportive globally as well, of course, but that's going to be something which matters a great deal. Just having another year of the economy being a global, a going concern globally, I think that's really important for confidence, which in the US, if we look at consumer confidence, it's been hit pretty hard. Actually, if we look at where the stock market is versus where consumer sentiment is, there's a big dichotomy there, and it's even worse in Europe.
It's really a difficult narrative to get my head around. Pretty much the entirety of this year is going to be a difficult thing to get my head around. But I'm wondering, people say the commodity costs are going down because oil prices are going down. And then we look at copper, then we look at lithium, then we look at some of the other inputs at all-time highs, continuing to skyrocket at gold and silver, et cetera. So some of the other inputs that we're going to be using increasingly, electricity costs. So how do you square this idea of the disinflation from oil prices and, frankly, the inflation from the rest of the commodity sector, which a lot of people are betting will continue?
Well, I think you put it into the chain it works in. The push up in commodities prices is a symptom of the investment that's being made. And the investments that are being made at the moment are in building productive capacity. It's in electrification, which will ultimately bring down costs. It's also in data centers, which is a huge part of the AI sort of infrastructure build out. We're going through a massive building phase at the moment, a phase where we're building productive capacity. And we know that the biggest driver of total factor productivity over the long run is the investment made in those productive assets. That's what we're seeing today. Yes, of course, there's going to be tightness in places. I mean, the swing demand today for copper is not China as it always was for many, many years. It's much more what's going on in terms of electric vehicles. It's what's going on in terms of data centers. So it's a symptom, I believe, of a bigger theme, which is this big investment phase that we're seeing right now.
You say that you're becoming more constructive on Europe, specifically Germany, this made in Germany. How is that possible when China has been decimating their industrial base?
Well, I think we've got a few things. I mean, this is not new news. You know, Chinese competition in Europe has been a big deal for the European Union for some time. There's been a lot of talk about concerns over product dumping, that sort of thing. But what's been happening beneath the surface is that you've gone through a couple of years of German industrial production really being on its knees. Very little inward investment, very little infrastructure investment. And really what we saw last year was the opening up of the fiscal taps, very rapidly followed by opening up of capex taps. Now, European savings rates for households currently sit at 15.3%. That's the highest level outside of the pandemic. You've got the biggest consumer bloc in the world not spending. This year, we've got incomes now rising above the pace of inflation. Start to turn that back on. And I'm not suggesting European consumers suddenly become US consumer-like, but just at the margin, that can give a big boost. And although the PMIs earlier this week were a little bit softer than expected, they're still coming in line with a 1.6% GDP growth rate, which is, you know, half as much again as the growth rate in the first half of last year.
Do you think the German fiscal impulse translates to the rest of continental Europe?
Not necessarily, because this is the issue with Europe, or what holds it back in many regards, is not everyone has the same fiscal space. But make no mistake, I mean, Germany still remained the biggest bloc within Eurozone, and it really is the heartland of industrial production within the Eurozone. So really sort of getting that piece right to sit alongside some of the strength we've seen in Spain, other parts of the periphery, and offset some of the concerns in France, that's a big deal in terms of taking it from a continent that many folks had forgotten, that still managed to do, in dollar terms, 30% on its equity index last year. And all of a sudden, it can come out and surprise people.
John, can we finish on a simple but I think highly consequential question, which is, what are the indicators I should track this year and what should I ignore? We've got ADP in about 6 minutes' time. We've got payrolls on Friday. If I tracked those and just said, you know what, based on that data point, I'm going to be long or short this equity market, I'd have got things very wrong in the last 12 months. What should I ignore? What should I pay attention to?
Well, I think, you know, if only there was one indicator we could all watch. I mean, you know, but then, frankly, I'd be out of a job. So,
well, what do you think is going to help you more?
What I think matters most of all is the fundamentals. It's what are companies doing? Are they able to translate this massive investment flow into earnings? Remember, with the labour market, we've gone through a seismic change last year. We've gone from a huge oversupply, a lot of excess capacity coming into the labour market. That's now gone. So we've gone through that sort of right sizing, if you like, of the labour market. It's a much lower level of payrolls needed to keep track with trend GDP growth. It's in the 50 to 60,000 range, not in the 200,000 range as it was. So you're talking smaller numbers. But at the end of the day, America's superpower is its corporate sector. If its corporate sector is building profits and it's creating a positive return on the massive investment that's coming through, then that's a reason to be constructive.
Earnings season starts next week. John, it's good to see you.
Good to
Thanks
see
for
you
dropping
too.
by. Thank you, sir. John Bilton there of JPMorgan Asset Management. ADP numbers drop in about 5 minutes' time. Before we get to that, let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. JPMorgan's asset management unit is cutting ties with proxy advisory firms. Sources telling us here at Bloomberg, the unit will instead use an AI-powered platform called Proxy IQ to assist with voting U.S. company shares. JPMorgan thinks it's the first large firm to entirely stop using external proxy advisors. Meanwhile, President Donald Trump said Venezuela will send up to 50 million barrels of oil to the U.S. That's worth roughly $2.8 billion at the current market price and represents about 50 days of Venezuelan oil production. Sources telling us here at Bloomberg that President Trump could meet with energy executives at the White House as soon as tomorrow. And Polymarket is refusing to pay out bets that said the U.S. would invade Venezuela, arguing the mission to capture Venezuelan leader Nicolas Maduro does not constitute an invasion. It says it will only pay out bets if the U.S. takes control of a Venezuelan territory. This after a wager netted more than $400,000 betting on the timing of Maduro's capture. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Up next, the latest ADP employment data set to cross. We'll catch up with Mike McKee to break down the numbers, plus Tony Wong of T. Rowe Price as the race for AI dominance continues to expand. Live from New York City this morning. Good morning. Live from New York City, welcome to the program. Moments away from the latest ADP jobs data. Before we get there, here's the price action. Down about 0.1% on the S&P, down by 2 on the Nasdaq. Let's get to the morning calls. First up, Barclays downgrading BJ's wholesale to underweight, noting concern around top-line momentum. Elsewhere, Wolfe Research downgrading Bank of America to peer perform, saying its net interest income upside is reflected in numbers. That stock is down by about 0.6%. And your third and final call comes from the team over at Canaccord, raising its price target on Alphabet to $3.90, noting Gemini's rapid scale. That stock this morning is down by a few tenths of 1%, but the big winner of the last 12 months, surprising many, Alphabet, Gemini, and really the strength that we started to see coming from that company. So that's the latest from some of your morning movers. Let's get the latest from the data. Mike McKee has more for you. Good morning, Mike.
Good morning, John. ADP is out with its monthly estimate of jobs created in the month of December. 41,000, they say. Annual pay up 4.4%. The change in private employment, of course, is 41,000. They don't measure what's happening with government. In the goods producing area, down 3,000. Manufacturing off by 5,000. Construction and mining add 1,000 each. Service providing jobs, 44,000. And of course, education and health services leads that pack, 39,000. But 24,000 leisure and hospitality jobs. We had seen a pullback in that area in recent months. Now the question is, does anybody really care about ADP since we're going to get non-farm payrolls from the BLS on Friday? So those numbers are back. I don't know if we get a shot of Lisa's face. She's always the one that reacts to ADP.
I'll just answer for it, Mike. I mean, the short answer for most is no.
She's probably rolling her eyes.
She cared about it for 43 days? Hold on a second. You know, a lot of people cared about it. The market did get a little bit tick of some sort of response, so
Sure.
yields a little bit lower. Carry on.
This is the bounce, Mike, we were looking for, though, right? And hopefully we get another bounce on Friday. How much should we read into this bounce, Mike?
Well, that's always a hard question with ADP. We did get a bounce, and we are expecting a bounce in non-farm payrolls. So in the sense of direction, yes, they may be offering some prediction, but in terms of numbers, it's never works out that way. I will point out that we have seen a steady rise in the forecast, consensus forecast for jobs. We're now at, let me check, the latest number is 66,000. So we've gone up another 1,000 since yesterday for the non-farm payrolls consensus forecast. Those are still low numbers, but remember, the Fed is looking not so much at those as they are unemployment.
Mike McKee, thank you, sir. Thanks for the update. ADP coming in at 41K, the estimate 50,000 for December.
There are some really interesting details here, and I do think it's important to note them. Service-providing jobs rose 44,000. You pair that with ISM services that we did get in a little less than 2 hours' time. Do we get the employment component there picking up to the same degree? Pair that with JOLTS, get the data on Friday. Do we get a sense that there is some heat underneath the employment market?
We'll come back to Mike a little bit later on that story. Let's turn to tech. Executives behind the AI trade, adding fuel to the big race.
AI is really going to be everywhere, and it's really for everyone.
Once we then realize that AI creates real-world impact, this is where it really deploys the full power and also the economic power.
This is really about being able to do the impossible and being able to do it the impossible right the first time.
Those executives speaking to Bloomberg's Ed Ludlow. Ed joins us now for more. Ed, welcome to the programme. We were saying earlier, great work in the last 24 hours. Ed, if there was a headline for you, walking away from CES, which hasn't wrapped up yet, of course, but what's the headline early on for you?
Yeah, 2026 will be a growth year. You know, the narrative that this kind of unstoppable AI wave continues is still there. And, you know, I did my best, John, to kind of say, well, are you worried about the debt that's supporting all of the infrastructure build out? What about energy as a bottleneck, particularly in the case of NVIDIA and Siemens, right? You know, Siemens is a company that we talk about less, but it's been around for almost 200 years and is basically in every factory around the planet. And, you know, at least in that context, I managed to get some concession from both Jensen Huang and the CEO of Siemens that there's a level of anxiety that they will always need more electricity, and that they're going to have to at some point think about that. But, you know, other than that, you know, this may not be the answer you're looking for. Nothing's changed, really, at least when it comes to those that are on the GPU side of the equation.
At that some point was kind of yesterday, last week, a month ago, maybe years and years ago. It's arrived. They've got to do something about the energy situation now.
Yeah, I mean, later on in the day, after we'd spoken with Jensen, he gave a press conference where there were several more questions about energy, and his concession was that reality is that they're going to need multiple sources. Natural gas is a word that he used, along with, you know, renewables like solar. I think what was interesting in the conversation that I had with him is that he went by geography and by region. So, you know, in Europe, he was acknowledging that there's a deficit there. And in the United States, more needs to be done. Then we moved to Asia, and he kind of paused and was like, in Asia, you know, also meaning China, actually, they've got their act together much more on the different sources of energy, particularly right on nuclear and the scale of their capacity. But it is certainly, based on the conversations of the last 24 hours, that is going to be a serious and hard conversation to have in 2026.
Ed, we'll let you get some rest ahead of the show in a few hours' time. Thank you, sir. Ed Ludlow of Bloomberg Technology. To build on this, Tony Wang of T. Rowe Price manages the Science and Technology Fund with tech giants like NVIDIA, Apple and Microsoft leading the portfolio. Tony writes the following: AI value creation is fragmenting rather than consolidating. For markets, that creates more investable opportunities, but also greater dispersion. Tony joins us now for more. Tony, always enjoy hearing from you, sir, so welcome. Just build on some of that and put some names around that story. What are you expecting this year?
Yeah, well, I think that over the last few years, there's been a lot of debate of, is this a zero-sum game? And I feel like, you think about what's happened over the years, like Google, Meta, OpenAI, Anthropic, they've all done really well. And I think that partially it's largely a market expanding opportunity here. And it's almost like the space race is on, but the space race is going to multiple moons. And so to me, it's exciting to see, various areas of value creation. For example, Anthropic's more focused on coding. You're seeing OpenAI in enterprise. Google's doing really well in search. And so they're kind of redefining different TAMs, and that's what's exciting, I think, as a tech investor.
We were talking earlier, Tony, about how in tech there seems to be a ball of money that's rolling to new fad places. And energy has been one area as a potential constraint, but so is memory. And we were talking earlier about SanDisk shares jumping 28%, Western Digital shares gaining 16% yesterday. This entire space getting a real sense of a reboot because Jensen Huang said this is the main chokehold. How much does this have legs?
Yeah, well, I think that the market's starting to recognize that memory is a really strategic asset here. And, historically it's been viewed more as a commodity. And I think that you look at like the bottleneck here, memory is becoming more of the, core bottleneck here. And so I think it's like HBM, for example, has been talked about in focus. But now also, due to like having the need for storage context, NAND is also a big deal now. And you see that Vera Rubin's going to have 16 terabytes of SSD NAND. And so to me, that's like a new, market for NAND. And I think that's pretty exciting and additive to kind of where the market is.
Have the results from some of the computing really justified the increasing costs? We heard Samsung overnight at CES talking about how they were going to end up raising prices because there just aren't enough chips and there isn't enough memory.
Yeah, I mean, I think that you're seeing, there's been, several years of memory oversupply, actually. And as a result, these things are generally cyclical. And I think that we're seeing a lot more secular growth from data center, and it's becoming a bigger market. And so I think that you probably will see more tightness. And then also now, like the market has consolidated in terms of there's fewer players and it's more rational and disciplined. And so, and the requirements for data center, for DRAM especially, are increasingly more difficult. So fewer players can actually do it. So to me, I think it could be more sustainable than previous cycles.
Tony, you say the most interesting opportunities are those that are quietly racing to less crowded moons. Can you give us some examples?
Yeah, well, I think that, when you think about what will really matter, I think, in terms of deploying AI, I think it's got to be a lot of, really specialized knowledge. And so I think when you're looking at deploying the enterprise, you see like Palantir, for example, really taking this forward deployed engineer approach. And so I think that's what it's really going to take. And it can't just be, just the frontier model alone. I think there's going to be a lot of specialized knowledge. And as a result, it's not going to be so much like accruing to one player potentially. So I think it's exciting that, you could see, beneficiaries across, various industries like financial services, healthcare, and as a result, see a broadening of AI impact here.
Not to get too existential, but Lisa did bring up a very good point yesterday in regards to Taiwan and the geopolitical concerns. Our entire AI trade is tethered to Taiwan. Does this concern you at all? How do you think about this in this day and age right now?
Yeah, well, it's definitely been a real concern over the last decade, really. So I don't think it's a new concern. There are definitely mitigating factors, but at the end of the day, I think that the world is super interconnected, and I think that as a result, I think the countries and the companies need to cooperate together and make sure that we continue to have a good existence and a collaborative one.
Tony, it's good to catch up with you. Thank you, sir. Tony Wang there of T. Rowe Price. Bit of a short visit there because I want to bring you this as a delicate developing story, and it's certainly a heightened geopolitical risk story for that matter as well. I'm sure many of you have been tracking this Russian-flagged Venezuela-linked vessel that's made its way up into the northern Atlantic. This, according to people familiar with the matter. The US at the moment is attempting to seize that vessel, of course, known as the Marinera. This is the information we have on hand at the moment. According to people familiar with the matter, they are attempting to seize that Russian-flagged Venezuela-linked tanker in the northern Atlantic. We'll come back to that story in just a moment. We'll also catch up with Kathy Bostjancic of Nationwide, looking ahead to payrolls on Friday. Plus, Danny has your morning movers with memory stocks very much in focus. From New York, you're watching Bloomberg TV. A strong start to the year, a strong start to the first full trading week of 2026, a three-day winning streak on the S&P, and this morning just about unchanged. Going into the opening bell 60 minutes away. On the Nasdaq, we're down 0.2%. With your morning movers, let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. Right before the commercial break, you all were talking about the huge run in memory chip stocks. It is taking a breather today after all of these hit new records, gaining at least 10%. In the case of SanDisk, more than 20% yesterday. Down about 1.4%, but it really was those comments from Jensen Huang that the main bottleneck is this that's been helping fuel the rally to start this year. Otherwise, some deal news that we're looking at. Mobileye, this is the autonomous vehicle company, has bought a robotics company, an Israel-based one, for $900 million. This means it joins the ranks of Tesla, of other autonomous car companies in both the U.S. and China that's looking at putting humanoid robots onto the scene too. Those shares up 13.7%. Finally, some sell-side action. First Solar getting a downgrade from Jefferies, saying that there's concern around tariffs, lack of any policy support coming from here, and frankly, just too high valuations. That downgrade leading to a share price drop in the pre-market of just over 4.3%, John.
Danny, thank you. Looking forward to more updates from you and the team in about 30 minutes time alongside Matt Miller to guide you towards the opening bell in 60 minutes from now. I want to get you up to speed on a breaking, developing story that we've been tracking. I know many of you at home are tracking the same story as well. A Russian-flagged Venezuela-linked vessel. That tanker has made its way into the North Atlantic, the vessel known as the Marinera. The latest we've got for you from our reporting is that the United States is attempting to seize that tanker. That a developing story happening right now.
And last night, the Wall Street Journal was reporting that Russia sent a submarine and some other naval assets to escort this tanker. This is pretty unprecedented in normal times in international waters. We would not board a tanker. So a lot of questions are going to be asked. Did the United States just board an asset of another country? Are they undertaking formal action against another government? And if the President of the United States is trying to set deterrence, what does this mean for the entire shadow fleet? Not just Venezuela, Iran, and a lot of that oil that goes to China.
Yeah, this is a sanctioned ship that had already been in the sights of the U.S. government. The U.S. had been tracking it. It had a Venezuela flag. It changed it to a Russian flag, potentially to avoid scrutiny. It avoided a blockade. A question here now from Moscow, saying that it's monitoring the situation with concern. Again, it seems to be escalating after what happened over the weekend.
We'll keep tracking this story for you. When we get headlines, we'll share them with you. Also notable and worth tracking too, the US Energy Secretary Chris Wright about to convene and participate in a fireside chat at the Goldman Sachs Energy Conference. So I imagine there might be some newsworthy questions for him once that starts.
Yeah, the question is, where do you even begin? I mean, not only with respect to government support for any kind of intervention or development in Venezuela, but also what is going on in terms of what the parameters are and how far the U.S. will be willing to go, particularly for ships that already have been sanctioned.
And then going back to just the president's truth last night. The president said that Venezuela, their interim authorities of Venezuela, were his words, are turning over 30 to 50 million barrels of high quality. And then the president went on to say that money will be controlled by me. What exactly does that mean?
That's the latest. When we have more, we'll share it with you. Let's turn back to the data. Jobs numbers set to cross at 10 a.m. Eastern time. We had the ADP numbers just moments ago. Wrapping it all together is Mike McKee. Good morning, Mike.
Good morning, John. And don't forget ISM services coming up. Let's start with those ADP numbers because they do seem to have sparked a bit of a turnaround in futures, although we're back negative now. ADP reporting 41,000 jobs created in the month of December for the private sector. They don't measure government jobs. And it does suggest a bit of a rebound from a minus 29,000 in November, and that kind of tells you that maybe the labor market isn't falling apart, and that's made markets a little happier than they were. Will they still be happy at 10 o'clock? That's the question. The ISM Services Index expected to drop, as we saw with the ISM Manufacturing Index on Monday, and of course everybody's going to want to go under the hood, and this week, because of the jobs numbers, they want to look at employment, and the forecast there is for a very slight rise to 49 from 48.9, but that's still contraction. So that would suggest bad news for the Friday BLS numbers. JOLTS being 2 months behind doesn't give you as much of a heads up on what we're going to get in terms of the December payroll numbers, but the November JOLTS are expected to show a little bit, tiny bit of a drop in job openings. What everybody really looks at with them is the quits rate, which was 1.8% in November, and the layoffs rate, which was 1.2%. We'll have to see. Those don't get consensus forecasts, but we'll have to see if those worsen in any way to suggest that the labor market is slowing down, because it's all about how the labor market is doing right now and how the Fed would react to that.
It is the number one question without a doubt. Mike, thank you. Appreciate it. Mike Wright, also ISM Services, the one to watch a little bit later this morning. Just on the jobs data, Mike also right to point out the response in the equity market. This tiny bounce, but ultimately the initial bias is good news is good news.
Because right now you're not seeing job creation at a pace that's really going to reignite inflation fears in any kind of dramatic way. If we're talking about 40, 50, 60,000 jobs being created, not exactly going gangbusters, but not falling off a cliff. And I think that really is the sweet spot right now for markets.
Here's a view on Wall Street. This from Kathy Bostjancic of Nationwide, writing, expect the Fed to pause its policy easing over the first half of 26 to assess incoming labour market and inflation data. We expect 2 additional rate cuts beginning in June. Kathy joins us now for more. Kathy, welcome to the show. What's special about June? Why that mark, that circle on the calendar?
Yeah, good morning, John. Happy to be with you. Well, I think by then, at least our estimates showed that inflation has peaked and starts to trend lower. That's really important for Fed officials. And then, as you know, Fed Chair Powell's term ends in May, so we'll have a new head of the Federal Open Market Committee, and we think that person will, whoever one of the 3 leading candidates is likely to be more dovish. But I think the key is inflation peaking and starting to trend lower.
Right now, Kathy, we're talking about the potential for the Fed to ease financial conditions at a time where the conditions are quite easy. I was looking at the yields on high-yield bonds, and they've actually reached the lowest going back to 2022. You could see spreads really compressing. At what point does the Fed take a look at what's going on in financial markets as a reason not to ease further, to sort of hold off for now?
Yeah, great question. I think what I kind of look to is the comments Fed Governor Waller's made that yes, overall financial conditions are quite easy, but if you look at financial conditions for the consumer, especially those on the lower part of the K, right, the K-shaped consumer, they're really struggling, and financing conditions are not easier for them, right? Even though mortgage rates have come down a bit, 6.25%, that's still quite high. And then if you look at borrowing rates for automobiles, that's also still quite high. So I think that the Federal Reserve needs to take that into consideration. Think about Main Street consumer and still and they have the room to lower interest rates. No, we're not talking 100 basis points at this point, but 50 basis points helps, and I think it validates what's priced into the markets. That's key, because if the Fed is not going to cut 50 basis points, then yields actually would back up higher.
John was talking earlier about how it's going to be really interesting to see how the market responds, considering that it really hasn't responded much to the employment numbers. What kind of number could we get on Friday that would potentially wake up markets either to the upside or to the downside?
Yeah, employment's going to be really interesting because there's so many cross currents going on right now. So one thing I would say is when I looked back at the October-November data, I actually thought, even though the headline number was quite weak, especially for October, a lot of that was because of the government workers that had been furloughed or laid off, actually, finally rolling off severance. And you could see that hitting the data. But if you look at private payrolls, they hit firmed, actually. The 3-month moving average for private payrolls, 75,000 as of November. That was up meaningful from 13,000 in August. So I think the private sector has recovered. We'll see what the data show us on Friday. That's what's really going to be key for us. And I think your point, Lisa, that we're in the sweet spot. Good enough employment numbers. The labor market's not falling apart, but wage gains are moderating, right? So labor costs for companies are quite manageable, and I would say come far off the real boil point that we saw a few years ago.
Kathy, I know you think the uncertainty around policy changes is going to fade this year, but on Friday we may get a decision from the Supreme Court about IEEPA. How are you thinking about the impact of tariffs?
Yeah, so great question. That does give the potential to be a bit messy and increase uncertainty. I think even if the court rules that the IEEPA tariffs are not, constitutional, they're removed, I think the administration's really ready to step up with other options to put tariffs back on. So I think, in the long run, we're going to get, we continue to see these tariffs stay. And I think companies have been able to manage it quite well, I think better than many thought. And so I'm not looking for that to be a big disruptor. It could be a bit messy, no doubt. But I think the tariffs are here to stay. And I think companies, by and large, have managed them. And actually, the effective tariff rate, like when you look at customs duties, are less than what the announced tariff rates have been. And I think that's why we're not seeing as much of an impact on the economy and inflation than what was feared.
We'll be watching Friday. Let's see if we get a decision or not. Kathy, thank you. Kathy Bostjancic there of Nationwide. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. President Trump told House Republicans that they should turn around their political fortunes ahead of November's midterm elections. Trump warned that if Democrats retake control of Congress, he would be impeached for a third time. The president saying they'll find a reason to impeach me. Meanwhile, tensions between the U.S. and Greenland ramping up again. President Trump won't rule out the use of military force to acquire the Arctic island, as the White House says the administration is weighing a wide range of options. Denmark's prime minister warning that any U.S. attack on Greenland would spell the end of NATO. And Warner Brothers Discovery saying an amended takeover offer from Paramount Skydance is inferior to the deal it already has in place with Netflix. The board of directors writing in a letter to shareholders, Paramount's offer provides insufficient value and it doubts the company can close the deal despite a personal financial guarantee from billionaire Larry Ellison. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Up next, we'll set you up for the day ahead. Plus, David Rubenstein joins us of Carlyle Group as President Donald Trump is planning to meet with business leaders later this week. And we'll get you some of the breaking news coming out of the North Atlantic in just a moment. Live from New York City this morning. Good morning. A breaking situation this morning, a developing news situation. According to NBC News, U.S. forces securing a Russia-flagged tanker linked to Venezuela. The ship is currently sailing between Iceland and Scotland, with Moscow saying it's monitoring the situation with concern. Bloomberg's Simon Casey joins us now for more. Simon, welcome to the programme. What do we know about this tanker? Is it a Russian vessel or not?
It's a Russian-linked vessel, I think we can call it that. It's part of the Shadow Fleet, which is, many of you know, it's part of this global fleet of tankers that subject to sanctions. Frequently, they turn off their transponders. They sort of literally try to fly under the radar. And this was a tanker that was chased away from the coast of Venezuela last month by U.S. ships when it was trying to dock in Venezuela. As I say, it's a sanctioned vessel. President Trump in recent weeks has implemented this blockade on Venezuela to try to halt exports of oil from the country via sanctioned tankers, part of putting pressure on the regime. This was just before the seizure of Maduro, of course. So this tanker has been sort of chased across the Atlantic, essentially, over the past few weeks, and things have reached a head this morning.
Simon, what do you think the consequences are? And I know it's very early days. And I know it's maybe a little bit dangerous to go into the realm of speculation, but as you sit here and watch this play out, what do you think the consequences could be from a situation like this one?
Well, it's not the first tanker to be seized, of course. We had another sanctioned tanker seized last month. That tanker was full of oil. This one is empty, by the way. That tanker that was full of oil now sits off the coast of Texas. We expect that in due course, the US government will take the legal steps necessary to take ownership of that oil. In this case, the tanker that's just been seized today, it's empty. There are still questions why that particular tanker. As I said, there's this shadow fleet out there. There are many tankers on the ocean, some still in the vicinity of Venezuela. Why the interest in this one, we don't know. Is there something aboard that tanker? We can really only speculate at this stage. In terms of further ramifications, this has been quite a spectacle. We'll see what the Russian response is in due course, but it doesn't really help relations between US and Russia at this stage. There may be ramifications with the efforts to engineer some sort of ceasefire in Ukraine. So we'll see. It'll be very interesting to see what happens in the course of today.
Simon, if the US continues to go after the shadow fleets almost around the world, what would that do to the oil price?
Well, Venezuela it's a shadow of what it once was in terms of an oil producer. It produces currently less than 1 million barrels a day, probably substantially less than that right now, in a global market of over 100 million barrels a day of consumption. And we're in a glut at the moment. The oil price has declined quite a bit over the last 12 months. We think prices could even head lower this year, regardless of what happens with Venezuela. The world can live without Venezuelan oil. So there's no sort of significant market impact. Certainly consumers are probably not going to notice anything from this.
Secretary Wright right now is saying that Venezuela can increase output by 700,000 barrels a day in the medium term. What do you make of that? How quickly could we see a ramp up?
I think that's a pretty bullish assessment. If you speak to people in the industry who know Venezuela pretty well, we're currently, as I say, less than 1 million barrels a day. Its peak back in the 1970s was over 3 million barrels. It also reached close to that level in the 90s. But since then, the industry has gone on there in Venezuela has undergone real stresses, lack of investment, corruption, disrepair, you name it. There's a host of problems, and these are not going to be easy to fix. There will be some short-term fixes that if companies come in right now, spend a lot of money, maybe they can bump production a bit. But I think sort of, the significant kind of recovery, which is what President Trump was talking about on Saturday when he spoke from Mar-a-Lago, that's years away.
Simon, thanks for making time for us. Important conversation, developing story as we speak. Bloomberg's Simon Casey there on the latest. Annmarie, the US turning up the pressure.
Absolutely, turning up the pressure. To Simon's point, there's a lot of questions that we still need answers to. Is there something specifically about this tanker? Or is the President of the United States just setting deterrence in these waters that we do not care? These are sanctioned fleets, and we're going to go after them. And it comes on the heels, you have to remember, of his Truth Social post yesterday about how 30 to 50 million barrels of oil will be coming now into the United States from Venezuela.
What a start to 2026. Let's keep it on this story and others too. President Donald Trump honing in on his relationship with corporate America, planning a meeting with insurance and oil executives after a series of meetings with tech leaders last year. David Rubenstein, the Carlyle Group co-founder and co-chairman and host of the David Rubenstein Show Peer-to-Peer Conversations, joins us now for more. David, good morning. Congratulations on the latest interview with Ray Dalio. We'll get to that in just a moment. Lots of things have taken place already in 26. You're a man with fingers in a lot of pies. Can you talk to us about how the stage is set for corporate America in 26?
Well, corporate America has recognized that President Trump likes to make major decisions that can affect corporate America. So I think the CEOs of corporate America, when invited to the White House or to do something with the president, are likely to respond favorably to what he wants to do. Now, obviously, some may not politically agree with him, but generally they recognize that he can block a corporate deal. He can do things in terms of regulations that other presidents wouldn't do. So I think he's obviously got the attention of corporate America.
So when they sit down and have a conversation, they being the oil executives with the United States and the president of the United States, does that have to factor into their decision as to whether to deploy capital in a place like Venezuela?
Well, I think they recognize that the president is going to do certain things that are going to help the oil industry, I suspect, and he has said that publicly. So I think they recognize that when he says he's going to do something that's going to affect them, he's likely to do it. And so many of them are fairly responsive to him. They recognize that he's different than most presidents of the United States who don't usually get that deeply involved in corporate mergers and acquisitions, but this president is different.
We've also talked about the idea of a sovereign investment fund or something like that, and you've seen equity investments on the part of the U.S. government in a number of different companies. Based on your conversations with chief executives, is this something that's welcomed? Is this something that's even solicited?
It's not a major subject of conversation. Remember, we have a budget that is so gigantic that it's not going to be affected, and corporate America is not going to be affected by a sovereign wealth fund all that much because it's not going to be that big. Right now, we have an annual deficit of about $2 trillion, overall indebtedness about $38 trillion. And we're not going to have a sovereign wealth fund that's going to be big enough to impact that. And it'll take a while for the results of investments by a sovereign wealth fund to have any real impact on the federal deficit, in my view. But I think there should be a sovereign wealth fund. We've had one for years. It's called the printing press. Basically, by printing dollars, because we're the only reserve currency, we've had a sovereign wealth fund. And it's been enabled us to kind of do things we wouldn't otherwise be able to do because we're printing $2 trillion every year of money that we're spending that we don't really have. So we've had one. It's just not in the same form as the president's now talking about.
You have these wonderful conversations with leaders in markets and companies, and the latest, Ray Dalio, has been pretty vocal about how the era of Americana is coming to an end in some way or another, and how there is this trajectory. As the head of a company, as someone who talks with corporate executives, do you get the sense that they feel that when they talk internationally with their peers?
Well, remember, for such a long time, since World War II ended, we've been the only reserve currency in the world, and we pretty much dominated the global economy. We have about, 5% of the world's population, and we're about 18% of the world's GDP. So we're disproportionate in our influence. And I think it's very difficult for people to step back and say, all of a sudden the world's going to change. It happens more gradually. But people recognize that we're not going to be the only reserve currency forever. And we recognize we can't keep running up these deficits forever. And so I think corporate America is probably expecting some changes to occur. But I think a lot of people are waiting to see what happens in the midterm elections, which are going to happen this year. The president himself has said that he's very upset if the Democrats were to win the control of the House, because he said yesterday that they might try to impeach him. So a lot of people are going to look at the midterms and see what happens there. But right now, I would say the economy in the United States is in reasonable shape, leaving aside the deficit issue. Unemployment numbers are tolerable. Inflation is tolerable. If there are going to be big problems, we don't know exactly what they're going to be. Geopolitical events are probably more likely to impact the economy than any things that we're going to do ourselves. So what could happen with the Russia-Ukraine war, what could happen in Iran, what could happen in China, Taiwan, are more likely to affect the economy and the markets than anything we're going to be able to do by ourselves.
How much is geopolitics weighing on corporate America right now? How much is this the conversation in boardrooms?
There's no CEO that doesn't have a geopolitical advisor these days, because everybody recognizes that geopolitical events can affect them dramatically. For example, if you're in the oil business, look what's happened just recently. If you are in the agriculture business. Ukraine has gone through a major change, and they were a major exporter of wheat. So I think everybody has a geopolitical advisor, and everybody's sensitive to it. But in the end, you can't anticipate certain geopolitical events. When you tend to anticipate things that are going to happen, they usually don't happen. And when you don't anticipate them, that's when they happen. So it's very difficult to think your geopolitical advisor is going to make you much richer or smarter, because they really don't know that much more than you know yourself.
David, final question. How's LinkedIn going? How's social media working out for you?
Okay, so I would say no big problems. I thought you were going to ask me about Pete Alonso.
You wanted to talk about baseball?
Oh.
Well, I thought last time we were talking about the Orioles and so forth.
Well, I can fit in some baseball. I'd seen the latest news that Harvey had got you to join LinkedIn.
Well, I'm a technology last adopter.
I'm the same.
And I'm really reluctant to give up my BlackBerry, and I'm probably the last person who was using a BlackBerry. So finally, they convinced me to be on LinkedIn, but I don't think LinkedIn has really been dramatically changed by my adopting a participation in it. But I don't know. I haven't really linked in anything yet, but maybe I will.
I just got the message from someone else too, who just said talk baseball with.
Yeah, are
David Rubenstein.
you going to make that?
I'm sorry?
Are you going to? But yeah, he's a free agent. Are you going for the pitcher?
Well, I can't talk about that right now, but I would say.
You brought it up.
I would say, look, we spent.
Sounds like a yes.
I think of all the teams in Major League Baseball, the Orioles spent the second most in the free agency period of time since the season ended. So we've put in a fair amount of money, and we've got some really great new players coming on the team. Pete Alonso is the most famous of them, but we have a lot of other good ones, and I think we're in pretty good shape.
You're also a TV professional as well, because you know the time is up. So it's good to see you. Thank you, sir.
Thank you very much.
Appreciate it.
Thank you.
David Rubenstein there, the Carlyle co-founder and co-chairman.